If the inflation data continues to be held back by lower energy prices, it all softens the economic blow.
There should be a pullback in demand. We haven't seen it yet.
The consumer slows down, but the rate of change of inflation will jump.
Those that had the capability brought a lot of inventory, and going through that level of inventory has not yielded the pass-through to consumers that some have seen, but it'll come.
Ultimately, I do think that we're going to see more softness in the second half on activity.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday following 3 days without gains, the Nasdaq 100 suffering its second biggest one-day drop since April. As investors look to target earnings for another read on the U.S. consumer, economists on Wall Street will be passing some dated Fed meeting minutes as officials head to Jackson Hole.
Are we blaming Jackson Hole for the air pocket that we saw yesterday? Is it the potential for some sort of catalyst from Jay Powell coming out and saying, maybe I'm not going to cut rates next month, of course, in clouded economic language? Or is it that we did get some reports yesterday that indicated maybe some of the froth was getting blown off the top of AI? Either way, it feels like we're in a holding pattern, and people are trying to fill that holding pattern with one thing or another to justify some pretty significant moves based on at least the past couple of months.
These were some of the major winners of the past few months. Nvidia had a run of something like 90% off the April low. That's a stellar rally. If you look at the performance yesterday, strip out the muscle of big tech, outperformance on the equal weight. The rest of the equity market doing okay.
You could argue this was a violent repositioning, a sort of cycling within the equity market as people take a look at the 33 times earnings of the Magnificent Seven, saying it's getting a little bit heady at a time where people are talking about being priced to perfection and saying the rest of the 493 look better. If there are rate cuts, if there is the stimulative effects of the one big beautiful bill, all of a sudden we're looking at that perfect cycle that might benefit these other names rather than the big tech. Ultimately, are we just creating stories right now?
Later on this afternoon, we'll create another story. Fed minutes around. How dated are those Fed minutes?
Well, the one thing that will be interesting is Fed independence and how much that was sort of nodded to. Is that part of the discussion in any way, shape, or form? In terms of monetary policy, I don't think anyone's going to expect to take cues from these particular minutes. But the drumbeat is getting louder and louder when it comes to Fed independence. You hear about what's going on with some of the nominees, get them in quick. You hear some more aggressive, some aggressive tax on additional Fed governors, Lisa Cook. All of a sudden, it starts to be a real question of how they address that.
We had two big dissents at the last meeting. How much daylight is between the dissenters and the rest of the committee? That's one question. And after payrolls, how does the committee choose, the Federal Reserve, the institution, choose to massage these minutes just to reflect the fact that the chairman was calling everything solid in the news conference, and then the numbers we saw afterwards were less than solid?
Is there a sense of the confusion or the lack of certainty around what the data is actually saying? Is there a renewed emphasis, or did they just make them really short and say, we don't know, stay tuned? And that, I think, is what a lot of people are expecting.
There's a lot we don't know. We'll find out a little bit later how much the Fed doesn't know this afternoon when we get those Federal Reserve minutes going into Jackson Hole. We got some earnings just moments ago. Those earnings came from Lowe's. I'll start with the outlook. Lisa will give you the rest of the numbers. They see full year total sales. Here's the range, $84.5 billion to $85.5 billion. They had seen the previous range, $83.5 to $84.5. The stock is up in a pre-market, Lisa, by 1.4%.
Yeah, when you sort of bleed in the total sales, the adjusted EPS expected to be higher than expected. Full year CapEx also expected to come in higher than expected at about $2.5 billion. And this really is interesting. Lowe's is planning to buy foundation building materials for about $8.8 billion. The reason why I find this interesting is because A, we've been wondering when deals are going to come back. B, there's this feeling that the bigger that a company is, the better position it will have to manage through a lot of the tariff situation. And C, this really suggests a certainty, maybe a picking up at the bottom, this promise that maybe there is a better future forward, at least for the housing market, which has been perpetually beaten up.
A beat, a raise, and an acquisition. The stock is up in a pre-market by 1.5%. We'll come back to earnings from retailers a little bit later on this morning. Target at about 6:30 Eastern Time. Coming up this hour, we'll catch up with Brian Nick of NewEdge Wealth on the sell-off in big tech. Scott Lincicome of the Cato Institute as the White House looks to invest in chip makers, and Eugenio Aleman of Raymond James following earnings from Target. We begin this hour with stocks steady following the Nasdaq 100's second worst day since April. Brian Nick of NewEdge Wealth writing it's hard to pinpoint an exact driver for the spark that caused the sell-off. In the thin trading days of August with crowded positioning, it becomes more about the dry kindling than the spark itself. Brian joins us now for more. Brian, good morning. Good to see you.
Good morning. Thanks for having me.
What was yesterday about then? Let's get into it.
Even with the benefit of hindsight, it's hard to pick a specific thing that happened. But the headlines, if you didn't read past them about Meta restructuring some of its AI organization, that could have supplied the initial concern sell-off, and then it becomes because there's very heavy positioning in these names and there is lingering concerns about what's going to happen on Friday with Powell. There just aren't those buyers to come in and scoop up these names the way there have been so many times over the past few weeks. And the interesting thing about this session will be, do we see a bounce back as people see there wasn't really much news driving it, or are those lingering concerns about Friday going to continue to kind of keep things
Do you see good reason for there to be a bounce back into Jackson Hole, into Friday, into earnings for NVIDIA a week away?
So I'm not sure that big tech is really the most vulnerable to risk on Friday. If there's a downside risk to Jay Powell's comments, it's going to be something that might ding home builders that are up 15% this quarter that have been largely an interest rate trade. If he comes out and throws some cold water on the idea that the rate cut is baked in for September, those stand to be some of the more vulnerable sectors. REITs also. AI has not been as interest rate sensitive. So there could be just overall concerns about what happens if financial conditions stay too tight and what that means for AI and AI capex and the economy generally. But I wouldn't put them at the top of the list of most vulnerable to a hawkish outcome this week.
This is a fascinating point, especially given some of the earnings that we've been getting. We just talked about Lowe's coming out, a beat and a raise. It's different than what we've seen from others. We've seen more motley kinds of performance yesterday. Toll Brothers had a more disappointing outlook, and there have been a number of others as well. Do you get the sense that we are bottoming out in one of the most pivotal industries of the United States economy, which is housing? Do you get the sense that could be a driver going forward? Or is that maybe a little bit of an inflated view? Yeah,
I'm concerned that we have 4 rate cuts baked in for the next year, and long-term interest rates really haven't come down much at all, and mortgage rates haven't started to come down. We're seeing people start to pull homes that they've listed off of the market in an increasing way, and that's not a healthy sign for the housing market. The building permits numbers were as weak as they've been in this cycle. We have the same number of building permits for single-family homes as we did in March of 2020, in the influx of the pandemic. So I would be concerned that if you're looking for certainty that long-term rates are going to come down and that's going to benefit the sectors like housing that it traditionally would, that we're just not seeing it yet. And even if we get those rate cuts, that's not necessarily going to bring down long-term rates if you have more stimulus coming, if you have uncertainty about inflation. And also the Fed not vowing to cut rates a lot, I'm sure. If Powell talks at all about cutting rates, it's going to be sort of incremental steps ahead. There's just as many people in the FOMC that don't want to cut rates at all this year as those that want to go twice.
So to put this together with the point that John was making earlier, how much does this make you want to buy this air pocket when it comes to big tech? If you don't actually believe that this is the overvalued part of the market, that in fact this is the most immune to some of the cyclical questions that we have that are vulnerable to a surprise in Jackson Hole, how much are you rotating back to big tech even after just a pretty small relative decline?
Yeah, I put this in a slightly different way, that if you wanted to look for sort of the biggest bang for your buck, if you think that we're in this sort of new inflection point, interest rates are going to come down, the 493 are going to start to do better, you'd be overweight things like mid cap, small cap, which we are not right now. We're underweight those areas. We're still overweight large cap, albeit more kind of on the value side. So we're kind of playing both sides of the fence a little bit. But yes, it's hard to find, if you're going to be in a slower growth environment, which we think we're going to be in this 1.5% growth environment, that's largely where consensus is too. In a slowing growth environment, you're going to pay a premium for high growth companies that aren't necessarily as cyclically sensitive as the balance of the market. And I think that's the signal we've been seeing all summer.
See this news on McDonald's. Wall Street Journal this morning. McDonald's lowering the cost of its combo meals after consumers were left sticker shocked by Big Mac meals that climbed to $18 in some places. There's some pressure on some companies out there. Might not be the NVIDIAs of this world, but certainly elsewhere.
This is the reason why there is so much confusion at a time where you have sky-high valuations in some sectors, at least relative to history, of how well the economy is doing, how much it matters to those valuations, given how divorced it has been, how specific it has been to big tech. We've seen this with a number of retailers competing on price to get market share, and we're expecting to see that with Walmart as well. What does that tell you about the health of the consumer?
Howard Marks joins us a little bit later from Oaktree. In his latest memo, he wrote about the calculus of value, and within that piece, he went through potential sources of worry. and he looked at the 493 and the Magnificent Seven, and really, based on my read of things, really pointed to the 493 as a bigger potential source of worry here.
And that seems to be what Brian is talking about as well, the idea that people say there are these inflated valuations for the Magnificent Seven, 33 times earning. But when you take a look at the 1990s dot-com bubble, or even before that, you're looking at valuations of 50, 60 times earnings. So this is a different time for a paradigm shift in tech. The rest of the companies, depending on a real change in the cycle, a real getting better of the world that maybe isn't quite happening.
Brian, can we finish there? Just the best benchmark for valuations right now. What is it? What is the appropriate benchmark for valuations? Do you break up the 493 versus the 7? What do you look at?
So we definitely look at the equal weight S&P, which doesn't look extraordinarily cheap. It's not as if everything else is at bargain basement prices and it's all being pushed up. Things like Schiller PE, which I think have their uses. One of the best projectors of long-term returns is going to be cyclically adjusted. That's in that above 35 times territory, where every time it's been there, it's not only been vulnerable to 5-10-year periods of underperformance, but really 1-year shocks as well. And we've really only been there a few times at the end of 2021 and at the end of the 1990s. So those are things that are kind of maybe not flashing red lights, but flashing yellow-orange lights when we're looking at the equity market.
Brian Nick of NewEdge Wealth. Brian, good to see you. Looking forward to catching up with Howard Marks later on this morning. I believe that's taking place at 8:30 Eastern Time.
Yeah, very curious to see where he sees risk and reward. The idea, maybe the risk lies in some stocks that people are saying are less overvalued than the Magnificent Seven. This question of how do you value some of these assets, a real key one.
3 days without gains on the S&P 500 could become day 4. We're down about 0.1% on the S&P. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Anand with more. Hey, Yahara.
Hi, John. We start with Lowe's. Shares are rising 1.4% in the pre-market after earnings. The retailer delivered a beat and raised its sales outlook for the year. The home improvement retailer also announcing plans to purchase foundation building materials for roughly $8.8 billion in cash. Meanwhile, sources telling Reuters that U.S. Commerce Secretary Howard Lutnick is looking into government equity stakes in Intel as well as other chip companies. The stakes will be in exchange for grants under the CHIPS Act. That piece of legislation was signed into law under the Biden administration to boost domestic semiconductor production. And over in the UK, inflation climbed to an 18-month high amid surging costs for food, fuel, and transportation. Consumer prices rose 3.8% compared to a year ago, exceeding expectations. The July reading does little to settle debate within the Bank of England over the path of policy after the tightest of decisions this month when rates were cut a quarter point to 4%. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, a new brand of U.S. statecraft.
As for this 10% government stake deal, the Department of Commerce continues to work on it. I know Secretary Lutnick is working on it and ironing out the details, but the president wants to put America's needs first, both from a national security and economic perspective.
That conversation up next with Scott Lincicome of the Cato Institute. Live from New York City this morning. Good morning. Howard Marks joining the program a little bit later this morning, 8:30 Eastern Time, on his latest memo, The Calculus of Value. Look out for that conversation a little bit later on Bloomberg Surveillance. To check out the equity market story right now, the price action shaping up as follows. Futures negative 0.1% on the S&P. We're down by 0.14 on the NASDAQ. Nvidia bouncing back just a little bit in this morning's session following the biggest one-day drop since April for that stock.
Today's the true test about whether this is a sell-off with legs, whether this is an air pocket that might just be bought. This, to me, is a real test. Do you see people come in and try to pick up the opportunities after a more than 1% decline in the NASDAQ for the first time going back to August 1st? Or do you see people saying, maybe this is telling us something? We should listen. The messages are coming.
Snoozy Wednesday coming right up. I hope, at least.
That's your.
I thought yesterday was
take.
going to be a snoozy Tuesday.
No, it turned out to be very exciting.
I got some abuse yesterday after the downdraft in the afternoon.
I told you. I mean, I basically warned everybody.
There's no catalyst for any of this.
That's the reason
Earnings
why
a
it's
week
happening.
away, Jackson Hole on Friday.
I mean, people are looking for things to do because they're bored, and then they fill that hole. So, you know what? It's not boring at all. It's very exciting. Stay tuned.
That's the equity story. Okay. Under surveillance this morning, a new brand of U.S. statecraft.
As for this 10% government stake deal, the Department of Commerce continues to work on it. I know Secretary Lutnick is working on it and ironing out the details, but the president wants to put America's needs first, both from a national security and economic perspective. And it's a creative idea that has never been done before to ensure that we're both reshoring these critical supply chains while also gaining something of it for the American taxpayer.
So here's the latest this morning. The White House looking to grow its stake in the nation's chip sector. Sources telling Reuters that Commerce Secretary Howard Lutnick is considering government equity stakes in additional chip makers beyond Intel. Bloomberg's Tom McKenzie joins us now for more. Tom, good morning, sir. What's your read of things so far this morning?
Yeah, is this statist capitalism with Trump characteristics? I'll put a question mark over that. What you don't need to put a question mark over is that this is clearly a more interventionist administration in the US right now. And the reporting, as we've been discussing this week, John, the reporting aligning with what we predicted or forecast, which is that this may be a Commerce Secretary, this may be a Trump administration looking to take additional stakes in other chip makers, because, of course, it's not just Intel that's received the funding from the CHIPS Act and is on course to receive additional funding. It's also the likes of Micron. They are front and center as well. Is this a Commerce Secretary willing now and wanting to take an equity stake for the administration, for the US government in Micron? What about TSMC? Of course, a Taiwanese company, or Samsung, both also big beneficiaries and to be beneficiaries of the CHIPS Act. There are corporate risk to this. That's what the critics would say. Corporate risks around this, risks around taxpayer funding. That's what the critics would push back on. But clearly, this is a Trump administration that is focused on key sectors and wanting to get something in return. If you want to have access, if you want to build out your foundries, if you want to get those subsidies, then we want something in return, seems to be the message.
Tom, you'd have to believe also there's real risk for some of the foreign earnings from some of these companies. We had this conversation yesterday. Intel gets about 30% of its revenue from China. If the story was the other way round, and we were talking about a chip maker in China and the Chinese government becoming more interventionist, we'd have big questions about their ability to sell into the US and Europe and elsewhere. Why wouldn't the opposite apply?
You would imagine, John, that the Chinese authorities will be putting that question and will be scrutinizing that potential scenario if indeed this is what this government does, taking that 10% equity stake in Intel. To what extent Beijing will use the infrastructure in terms of the regulatory framework it's put in place in recent years to put a noose around some of those shipments into the Chinese market as they, of course, continue to try and build out their own capabilities. I think that's going to be a key question going forward. And then, of course, the response from Taipei, if indeed TSMC comes under pressure. On terms of what happens around innovation and what happens around the US leadership on that front, does the Trump administration then pressure on behalf of Intel, the likes of Nvidia, the likes of Apple, to use Intel's foundries to manufacture their chips? That is another question going forward for investors and for those looking for the US to continue to lead when it comes to innovation.
Tom McKenzie, thank you, sir, with the latest out of London. It's a conversation we had with Angela Zeno just yesterday.
Yeah, and right now it seems like they're saying it's a non-voting stake. But what's to say that could change? We've seen non-traditional moves with NVIDIA and with others. I'm just wondering, the sands are shifting. They're constantly shifting. How do you get some sort of compass of what the overarching policy really is here?
You can see where this is heading. Ultimately, if you want a company to help build out domestic foundry capacity here in the United States, then also you want other companies, fabulous companies like NVIDIA, to use that capacity. So it's only a matter of time, you'd imagine, that the next step is to basically push those companies to do those things. Now, we've not heard that from the administration just yet, but I don't think it's a big jump in the logic of things to get there.
It's just there's another issue here, which is that this money is coming from the CHIPS Act's grants that haven't yet been distributed, that are now being converted into some sort of equity instrument. So how do we even get to that place? And what is this arrangement, this contract? What is it going to look like, given that, again, the shifting sands of what this actually means continues to be a theme?
On this story, Scott Lincicome of the Cato Institute joins us now for more. Scott, welcome back to the programme, sir. Let's start with the big question. What are the consequences for this economy from a more interventionist White House?
Yeah, I mean, I think you see several layers of consequences. I mean, start with a company like Intel or other companies that are receiving subsidies from the U.S. government, tariff protection from the U.S. government. Do these companies, if they're giving equity stakes and the rest, do they start producing things that are more for political value than for economic value? Ohio fabs, for example, for Intel, that big mega fab complex. Do those things keep going, not because they're actually good, productive investments, but because they're in Ohio and the U.S. government has a strong political incentive to keep them running? I think you also have concerns if you're competitors of these new national champions or customers of these new national champions. As we just mentioned, do American companies now, are they going to be pressured or even forced to use Intel's chips or these other things, MP materials and those minerals that the United States government now has a stake in? And of course, competitor companies that aren't getting this type of government benefit, does capital flow away from them and flow towards the government-supported champions? And then, I think the other big question is foreign reaction to all this. The United States government has long treated state-owned or state-invested enterprises as subsidy providers themselves, has long gone after these companies with tariffs and other measures of their own. Now, will foreign governments look at American exports from these companies and say, those are actually government goods or government subsidized goods? There really is a lot of Pandora's box issues that get opened with this stuff.
Before we even get there, Scott, and this was a point that John was raising yesterday, and I think it's an incredibly important point. How do we get from CHIPS Act grants to some sort of non-voting equity portion in a company? How do we transfer that? What does that mean in terms of whether companies are just going to reject some of the CHIPS Act money that they were promised that hasn't yet been dispersed? What can you understand about how this works out in a technical term?
Well, there's nothing in the law, to my knowledge, that allows the U.S. government to offer equity instead of grants. I think this is where you'd start seeing some very creative lawyering from the Commerce Department to somehow argue that they have this type of authority inside the CHIPS Act itself. But the other thing is that saying that these are going to stay non-controlling shares, I think, is a really dubious proposition. If the whole goal of converting this to equity is for the government to make money, and suddenly the stock starts dropping for these companies like Intel, or they start doing things that the government doesn't like with China, it's a really easy and small step for that to change to something that's more controlling from the government.
Scott, just finally, we've seen a whole range of agreements between trading nations over the last several weeks or so. Haven't really seen any real documents signed by both parties. Do we just trust this agreement exists? How does this work?
Well, the foreign governments are asking those same questions. In the Journal today, there's questions about when auto tariff relief is coming for the big Japan trade deal that was supposedly negotiated. I think the bigger question, though, is for companies on the ground. There's still no certainty in the market about the trading environment in these bilateral transactions between these trade deal parties because we don't have the text. Until then, we also have questions about not just the terms, but compliance. How do you determine whether a government is complying with these new market access promises? It really is all vaporware until we see something on paper.
Scott, appreciate your time. Thank you, sir. Scott Lincicome there of the Cato Institute. Keep going back to a theme of this programme over the past month or so. This is not an event, it's a process. And this process is a messy one so far. And we're all still trying to figure out the details.
And the devil has been in the details for a pretty long period of time. So how can we really even assess what the ramifications are? Again, the shifting sands of 2025.
You like that, don't you?
I do. I think that seems to be a theme.
Sum up the year so far.
I mean, it's definitely been shifting.
Like Dune.
No, I think, Dune, not Doom.
No, Dune.
Yeah,
Dune.
Definitely. Yeah.
Shifting sands
it's
and
really
what are
good.
those worms called?
That's what I'm saying. Like,
what
it's
are
not.
the worms?
I have
Who
no
are the
idea.
worms?
Really?
I'm just digging.
Yes, you are.
Trying to work it out. The sandwalk. That's what I was looking for.
Oh, okay.
A sandwalk.
Yeah, but what's the analogy, right? Like, who are the worms? I mean, I
The
just want to go
earthworms.
there.
No, I'm working with that.
Yeah, but the truth is...
Give me a few hours.
Yeah, I don't want to make it sound like an apocalyptic nightmare. I mean, this isn't the case. It's just changes are afoot.
Investors are doing the sandwalk. Is that where this is going? I don't know. Like, you made this happen.
I did not make this happen. Shifting Sands of 2025 has this great poetic meaning. It doesn't mean apocalypse now.
Okay. Futures, negative by 0.1% on the S&P. We're down by 0.2 on the Nasdaq 100. 3 straight days without gains on the S&P 500, the longest run since the start of August. Let's get you some movers, some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. A few earnings this morning. 30 minutes ago, we heard from Lowe's. What a reaction, up 4.5%, a positive reaction, much like Home Depot for them. They are buying a North American distributor of interior projects for $8.8 billion, so moving more to the kind of corporate sector versus just retail, but also their earnings themselves, everything in line, and upgraded their full-year outlook despite some of the economic tensions. So that is being well received. What is not being well received was Estee Lauder's earnings. Those shares plunging in the pre-market trade, at one point down 14%, now down just under 9%. It is a full-year outlook that disappointed, and perhaps part of that has to do with tariffs. They said that they're going to book about $100 million on tariffs for the coming year, saying that they're looking at ways to mitigate that. Of course, they're also highly exposed to China, so that is hurting them at the moment. Finally, we heard from Toll Brothers after the bell yesterday. Their earnings also disappointed, despite the fact that they're more exposed to the luxury end of things. They downgraded their outlook for sales for the whole year. Orders missed for the current quarter. The CEO talking about, we're resilient. There are just some economic stressors. Barclays took a look at their earnings and said this confirms the slowly but surely weakening housing market. Those shares down about 2.75%, John.
Danny Berger with the latest. Danny, thank you. That stock getting knocked around. That's the latest story in the pre-market. Here's another one. It's from Target. Earnings just dropping. We need to deal with two separate things here. The earnings report and then a C-suite change. The stock is down by 2%. I think we should probably start with the C-suite change. Brian Cornell stepping down.
Yeah, and he's going to be joining the board of directors. But the chief operating officer, Michael Fidelike, who was the expected successor, is going to be the successor as CEO. He will effectively be the successor on February 1st. So there is this transition period. But all of a sudden, this really shifts the focus of the earnings call to exactly what is Michael's plan to reshape the company, give it profitability that it hasn't had in the past. The earnings were better than expected across the board, with comp sales in particular down just 1.9% versus the estimated 3.02%. Nonetheless, it's the strategy going forward. How do you compete with behemoths like Walmart, like Amazon?
So that's going to dominate the call a little bit later. Let's spend some time on the numbers and some of the guidance. Just a review of the quarter so far coming from the company. Traffic sales trends improved meaningfully compared with the first quarter. All 6 core merchandise categories saw comp sales gains versus Q1. Stock's not doing well off the back of any of this, but it just speaks to the fact that we did see a bounce back in the second quarter relative to some of the nervousness to start the year.
Yeah, I'm very curious to see exactly what they did with inventory, how they got customers back, given that they did have a better than expected showing. And we have seen some real kind of contradictions within the retailers, like McDonald's, for example, lowering prices. That would indicate some sort of softness when it comes to consumers. Then you see better than expected earnings at places like Target. Is this a competitive strategy? Is this because pricing wasn't necessarily that much of an issue ahead of tariffs? Or is this that there is this underlying strength in the U.S. consumer that maybe people are underestimating?
That's the broad story beyond the industry. What about within the industry? You've been on top of this story now for years. Walmart really going after Target in a bigger way. Walmart, by the way, reports tomorrow. That competitive effort from Walmart has hurt this company.
How do you deal with a company that has a broader mix of products that at one point was thought to be the cheaper side of the retail world? Target was sort of the cliche, the idea that it has higher end types of goods. Well, Walmart's trying to get into that a little bit more and trying to cater to a wealthier consumer while also sticking to the grocery sector, while also building out their online presence. How does Target compete with that in a material way? That is what people will be looking for on this call. It's really been an issue. And right now, you're seeing maybe some better than expected earnings, but clearly the stock indicating there is some concern going forward, given the fact there are huge competitive disadvantages that they have right now. And this is a very difficult landscape that they're dealing in.
The stock down 10% in early trading. Michael Fidalka, the incoming CEO, saying, I'm stepping in with urgency to rebuild momentum and return to profitable growth. Going on to say, I've seen us at our best and I've seen us when we are not at our best. And that informs my candid assessment of today, where we have work to do.
Yeah, and that's certainly the case. I mean, right now, you saw what we've seen is 2 straight years of not necessarily growing earnings. And you've seen inventory messes where they bought too much and then they didn't have enough. How do you turn that around at a time where there is a very complicated competitive landscape, especially given Walmart that on Thursday is likely to come out and saying, we're going to compete on price?
Those earnings about a day away. Let's stick with retail and the US consumer. Eugenio Aleman of Raymond James writing the following. Inflationary effects from tariffs should start making inroads into those nominal retail numbers, and we should expect to see weakness in consumer demand during the rest of the year. Eugenio joins us now for more. Welcome to the programme, sir. What's your read on the US consumer? Let's just build on what you said there. And how broad-based will that weakness be?
Yeah, we have been seeing weakness in the US consumer for a while. The first 2 quarters of the year were relatively low, weak. And as we expect the full impact of tariffs continue to make inroads, we are expecting the consumer to continue to slow down. So our third quarter and fourth quarter expectation is very, very weak, very, very close to recession. We are still not calling a recession. We have 50% probability of recession, but it is a very smooth slowing down of the consumer. There is no falling off of consumer demand, but it is weakening. I mean, we have seen employment numbers weaken considerably, and that is going to continue to keep the consumer contained.
Can we focus on the potential for further bifurcation within the consumer? Eugenio, this came from the Bank of America Institute, and they said total credit and debit card spending per household increased 1.8% year over year in July, the highest growth rate since January. So a bounce back in spend in July coming through the summer. But they also said this, the difference in wage growth between higher and lower income households, the largest since February 2021. Is there something more regressive about the policy effort of the past few months that you see playing out in a much more negative way in the months to come?
Yeah, it is clear that tariffs are very regressive, affect the lower income individuals or households compared to the higher income. And we have seen this wave of a splitting consumer, let's say, in terms of income for a while. I mean, we also have student loans that are going to have to be repaid again. So those spendings are going to come down on discretionary side of the economy. So yes, I mean, we are concerned that this bifurcation of the consumer through income levels will help to weaken the consumer even further.
How much do you see some of the retail sales data that we've been getting is somewhat clouded, Eugenio, given the fact that inflation has been present? You have seen a couple of key goods really see pretty significant inflationary pops, and that's included in the absolute number that people then say, look, it shows the consumer is strong, the consumer is robust.
Yeah, I mean, the biggest issue with retail sales is that they are nominal, correct? The DEA used to calculate some real retail sales, but they don't have enough resources, so they no longer calculate them. So every time that we see nominal retail sales, we say, wait a second. Yes, it was relatively strong in July, but you have to take into account that most of it is probably price increases. So that is one of the reasons that we say that the consumer demand has been slowing down. So you have to take away the increases in prices. We are seeing some increases in prices. A third of consumption is goods. So those are the ones that are most impacted by tariffs. And they are goods that affect the lower end consumer more than the upper end consumer. So it is concerning. We don't see a crisis. We don't see something falling off right now. But the shock from tariffs is going to continue to make inroads into consumer demand.
Eugenio, appreciate your time. Eugenio Aleman there of Raymond James, the latest on the consumer. On retail earnings that we got just moments ago from Target, that stock getting hammered, by the way, in the pre-market. And a look ahead to what we could hear from the Federal Reserve. It's going to dominate the next couple of days into Jackson Hole.
Yeah, that's what I was thinking as Eugenio was talking. What does the Fed do with all of this, especially given the point that you made, which is a really salient point about how upper-end consumers could keep spending. They keep kind of padding the numbers. Lower-income consumers struggling. To me, the Target news, the reason why the shares are down so much, it seems, at least this is the interpretation of analysts, is people were hoping for some sort of outsider to take over, to get a new approach, not someone who started as an intern at the company in 2003 and rose up through the ranks. This is the key question. How does this company get that competitive edge back at a time where competition is so stiff and so dominated by Walmart and Amazon?
Stock is down by 8% in the pre-market so far. More on that story throughout this morning. Let's get you an update on that and a whole lot more with your Bloomberg brief with Yahara. Hey, Yahara.
Hi, John. Target shares, as you said, are getting hammered in the pre-market after the retailer reported earnings and announced its next CEO. Veteran Michael Fidelki will take over in February after, as Lisa said, starting as an intern at Target in 2003. Performance improved for the company last quarter, but it is still looking to regain its footing. Walmart is expected to report earnings tomorrow. Meanwhile, the Wall Street Journal is reporting McDonald's will cut the cost of its combo meals. The fast food chain and its U.S. franchisees are reportedly keeping the price of 8 combo meals 15% under the sum of the individual items. The Journal says McDonald's will offer a $5 breakfast and $8 Big Mac and McNugget combo meal later this year. And Japan's exports fell 2.6% in value in July from a year earlier, their steepest decline in more than 4 years as U.S. tariffs continue to weigh on trade. The downturn led by cars, auto parts, and steel was the biggest since February 2021. Meanwhile, export volumes rose by 1.2%, suggesting exporters are continuing to absorb U.S. tariff costs. That's your Bloomberg brief. John.
Yahara, thank you. More from Yahara in the next 30 minutes or so. Up next on the program, shades of stagflation.
There are shades of stagflation in the data right now. I don't think Chair Powell is going to commit to a rate cut. I think he's going to just signal the easing bias. So we might hang around here.
That conversation up next with David Seif of Nomura. Live from New York City this morning. Good morning. You're watching Bloomberg TV. A change at Target. That stock is down in the pre-market by close to 8% so far in early trading. Brian Cornell stepping down. Michael Fidelka stepping up. Long-time Target executive taking control of this company.
At a key point when they have to figure out how they're going to compete going forward after a couple of years of slumping earnings, slumping comparable store sales, they still had a decline in the recent second quarter sales report, but still not as much of a decline as in the past. Key question here is, what are they going to do with inventories? What are they going to do with tariffs? What are they going to do with pricing? And how are they going to invest in some sort of technological footprint to compete with delivery behemoths of Amazon and increasingly Walmart?
It's going to be an interesting call with that company later on this morning. We're down by 7 or 8% later on this week. Tomorrow, we will hear from Walmart, that company Lisa just mentioned. Equities on the S&P 500 shaping up as follows. A run of no gains on the S&P, a 3-day run so far, and could become day 4. We're down 0.1% on the S&P. On the Nasdaq 100, negative by 0.24%. Under surveillance this morning, shades of stagflation.
Markets across the board are pricing in a soft landing and what Governor Waller called good news rate cuts. There are shades of stagflation in the data right now. I don't think Chair Powell is going to commit to a rate cut. I think he's going to just signal the easing bias. So we might hang around here. I think where the disappointment will come in is no commitment, But I'm going to be watching that framework review.
So here's the latest this morning. Investors looking for signs of slowing economic growth ahead of Fed Chair Jay Powell's speech from Jackson Hole on Friday. David Seif of Nomura writing, while we see both upside and downside risks to the economy, our base case is lackluster growth of about 1%. Joining us now, David himself. David, good morning.
Good morning.
What do you think the emphasis will be on Friday from this Fed chair?
I think the emphasis is going to be on keeping options open. So certainly the Fed will continue to have an easing bias, but I think that very much unlike last year when Powell made it clear that a cut was coming in September 2024, he's going to keep his options open here. We think they're going to cut in September, but a year ago we were talking about, are they going to go 25 or are they going to go 50? So it was very easy for him to signal a cut of some magnitude and not give up any optionality. Now we think 25 is the most likely, but if we were to get on September 5th a very strong jobs number or on September 11th a very hot CPI, then I think there is a real risk that the Fed continues to hold off.
He thinks the labour market is solid. At least he did. And then we got payrolls. He anchored that view around one data point, the unemployment rate. Do you think he'd still call this labour market solid?
Solid is maybe overstating it a little bit. We've definitely seen a big loss in momentum. Now, is it as bad as that one labor market report, the August 1st report, showed? Probably not, or at least there's a lot of uncertainty when it comes to that. So it was a weak unemployment. It was a weak 4.2, meaning it rounded down to 4.2. It only stayed at 4.2 because a lot of people dropped out of the labor market. But at the same time, 4.2 is 4.2, and you don't want to overstate or underappreciate how strong it is. NFP looked pretty terrible, and there's no real way to spin the top number. So we have 3 months where it's average only 35K per month. And, they have to be a little bit worried about that. So they don't want to overreact to one single data point. But I do think that barring something that is very strong on September 5th, they're probably going to be cutting at the next meeting.
You said there's no way to spin that. And yet we've heard a lot of people try to spin that. Just to let you know, a lot of people
Yes.
have come on this show and they've said, actually, it's not as bad as it looks because of the immigration story, because of the supply side of the story. How much do you expect the Fed to address that? Are we going to see a non-farm payrolls headline number that is going to be materially lower for the foreseeable future, not because the economy is falling off the cliff, but because of this low hire, low fire type of dynamic?
Well, certainly after saying there's no way to spin it, of course, I'll give you all the reasons that you could. It's still going to be a bad number, but there are a couple of things. The first thing is certainly the break-even non-farm payrolls rate, the number that need to be created each month to keep the unemployment rate steady is down, we think, at least 50K per month, and some other estimates say it's down even more. And that's exactly because fewer people are coming into this country through immigration, and therefore fewer jobs need to be created to absorb all those people. The second thing, and I think this is also important, is this is actually the third straight year where private payrolls, education and healthcare, have gone negative on a 3-month basis. And in 2023 and 2024, this led to speculation that a recession was imminent. And what happened in both 23 and 24, we saw huge recoveries in the labor market in the second half of the year. Now, for a third straight year, we're seeing that pattern again. And it's not enough to make anything conclusive at this point, but it does make you wonder, well, are there some seasonality issues that have developed post-COVID in the data that we're just not able to get right? 3 data points, again, not enough to conclude that, but it certainly is a risk. And if there is some sort of seasonality in the summer where that's not being picked up, then again, maybe it wasn't as bad as it seems.
Yeah, and if we rewind to last year, that was the justification for 100 basis points of rate cuts that ended up some people really questioning in terms of just how weak the economy was. You add to this the one big beautiful bill. You add to this feeling that we're getting from a lot of companies that are reporting that actually they do have more confidence about policy. They do have more confidence to make acquisitions. What's the risk that there's more upside, that people are not discounting or not accounting enough?
There's definite risk here. And so, what you've heard from some of the members of the Fed is, well, maybe we cut in September, but we don't signal that we'll cut again in December. It is our expectation at Nomura that the Fed will cut in September and December. But even if they cut in September, it's then not going to necessarily be a slam dunk that there'll be a December cut. You have to look at, well, do we see signs of tariff-induced inflation coming? We certainly haven't seen it on a robust basis so far. Do we see signs that the labor market is roaring back in the way it did the last 2 years? And do we see a pickup in investment due to the accelerated expensing from the OBBBA, or from simply something totally separate, which is that companies right now want to plow a lot of money into AI investment, and that is GDP, however you cut it.
The range of outcomes that you say is really quite wide. I'm going through your note right now. We expect a 25 basis point cut at the next meeting. We also see no cut and a 50 basis point cut as possibilities, with no cut more likely than a 50 basis point cut.
Yes.
Just how wide are things right now, the range of outcomes that you foresee, and how different is that to the experience of the last few years?
Yeah, I mean, last year when we were at Jackson Hole, it was very clear that the labor market was getting a little bit worse. Maybe it wasn't getting as much worse as it looked, but it was getting worse. And inflation was still high, but it was unambiguously going in the right direction, getting lower. And so it was very easy to tell what the direction of travel was, even if it wasn't clear how quickly we were getting there. Now we have a labor market report that looks a bit like an aberration. We have a lot of expectations that these tariffs may cause inflation, and yet we really have not seen that in a robust way. And certainly the July report, to the extent it was a little bit hot, it was something that was not related to tariffs, and in many cases isn't going to feed into core PCE, which is the Fed's preferred metric of inflation. And so you put that all together, and there's a lot of new information that we're going to get from the September 5th and September 11th labor market and inflation reports that we just don't have right now. And both of those reports come before the next Fed meeting.
If Mohammed Al-Erin was here, he'd talk about regret minimization. I always said that these guys are in the risk management business. Ultimately, if you're in the risk management business, what is the prudent thing to do in September? Some people might say it's wait. Is that not the prudent thing to do?
I think that if we didn't have those two data points, it would be a very, very close call right now. I still think they would probably cut, but you could spin it the other way and say, well, if we are weakening and we fail to cut in order to start to alleviate that weakening, maybe that's actually the bigger mistake. And, when we look back at the 50 basis point cut from last September, certainly based on the data that subsequently came out, it was unnecessary to do. I think there's no question about that. But do I think the Fed regrets having made that cut? Probably not, because it seemed like there was a chance that we were deteriorating more quickly. And so it was worth putting this in there, again, from that risk management perspective, lest there was a bigger downturn coming that they hadn't reacted to.
It was odd listening to Chairman Powell reflect on those rate cuts, because I think he said something like, if anything, we were late.
Yeah.
Which is an odd way of summing up what they did last year.
Given the fact that you saw a 100 basis point increase in yield at the long end of the yield curve, I just am thinking regret minimization would be a great self-help book. That would be a great name of a self-help book, how to understand how to make decisions, minimize regret.
Mohammed might write the book.
Okay, please do. Because
but
I actually,
just for Chairman Powell, because I know how well those two get on.
I think that would be lovely. I'm sure that it would be steeped in all sorts of lovely
David Seif of Nomura. David, thank you.
My pleasure.
If you really wanted to upset Chairman Powell, I imagine putting Mohammed on the board right now would be one way of doing it, wouldn't it?
I would guess that would be the case.
I haven't seen his name in the mix, but, maybe they can make that happen.
You're trying to put him in the mix?
Just throwing that out there.
There are 11 candidates. What's another one?
It was his birthday yesterday, so happy birthday, Mohammed.
Happy birthday.
And maybe that's a gift coming to you from Secretary Besson sometime soon. Got no idea. Up next, Eric Freedman of US Bank, Monica Guerra of Morgan Stanley, Erica McLaughlin of the Conference Board, and Greta Peisch of Wiley Rein. From New York City, this is Bloomberg.
I think markets across the board are pricing in a soft landing.
The market is taking into account that there is potential for there to be upside.
When you don't have a lot of margin and there's uncertainty, there's nothing you can really eat.
What you've got is an economy that's very strong around tech.
The big spend right now is still in technology, so those stocks are at a premium valuation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
3 days without gains on the S&P 500, about to become day 4, perhaps. Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. We pulled back slightly in yesterday's session. On the S&P, we're down again by 1/10%. The underperformance yesterday on the Nasdaq, it continues this morning, down by 0.2% on the Nasdaq. Some good news maybe, stabilizing for Nvidia. If you ask people this morning what happened yesterday, I tell you what, there's no consensus whatsoever on what happened yesterday. It's the summer. Thin trading. Things happen.
People still blame Citron, for example, coming out with a report about Palantir valuation versus OpenAI. Some people pointed to other reports questioning just how much companies are profiting from their AI investments. Nonetheless, the true test, as you said, is do people buy today? Do people see this as a buyable dip after this being the first decline of more than 1% going back to August 1st? To me, that really highlights just how somnolent and how much of a one-way train up this is and how much people are looking for excuses to shake it up in any which way.
We'll go to another excuse later on in the hour. We'll talk about an MIT report on AI. Saw that too.
I'm excited about that, actually.
Yeah, we'll get into that in about 30 minutes' time, so look out for that conversation. Also going to get into this. Target is down by about 8% in the pre-market. That's a name to watch. A management change at one of the biggest retailers in this country.
Yeah, they shifted the chief operating officer, Michael Fidelki. He has been named the next CEO. This has been the big mystery. Who will Target pick to be their succeeding leader? His appointment will take effect on February 1st. This is somebody who grew up at the company, has been at the company since 2003 when he started as an intern. And he said that recent efforts to turn around some of Target's fate have been paying off, including this initiative, which is dubbed Fun 101, which seeks to capitalize on the latest trends for products, including sporting goods and electronics. I cannot think of anything more corporate than saying Fun 101. Here is a flowchart of fun and how we're going to apply to it.
When they talk about fun at corporate America, it never is.
It's a problem.
But it's usually someone who's sort of overexcited about their initiative internally.
When you have to have
eye rolls around the room.
When you have to have a flowchart talking about the different parts of fun and what makes this ball fun, you're sort of taking the fun.
You get these elbows, sort of like, indulge them. And then you're like, summer picnic, excited for that. Sunday with everyone else.
You're on a roll.
Company.
Nonetheless, look.
To see people I work with.
I'm going to save you because ultimately it sounds like you're kind of hating on some of these meetings that we have, which I personally love. I think that the real question here is how are they going to compete in a highly competitive landscape and how do they deal? I'm talking about Target now, not the meetings that you're going to. And how does Target really look ahead to tariffs, to pricing pressures globally, to a consumer landscape that is somewhat questionable right now? How do they manage that after all their inventory problems and as they have flowcharts that are about Fun 101?
When your company starts talking about fun, run. Equities right now in the S&P 500, negative by about 0.1%. Coming up on this program, Eric Freedman of US Bank following big tech's second worst day since April. Monica Guerra of Morgan Stanley as the White House is fast-tracking their next Fed pick. And Erin McLaughlin of the Conference Board with retail earnings very much in focus. We begin this hour with stocks falling, led by some of the year's biggest winners. Eric Freedman of US Bank writing, as long as CapEx continues and technology diffusion occurs at a measured pace, we see further upside, but would not mind a pause that refreshes. Eric joins us now for more. Eric, welcome to the program, sir. Last time we spoke a little more than around a month ago, I remember you were maintaining that overweight, risk-on posture. Eric, are you maintaining that posture going through summer?
Yeah, Jonathan, we are. Great to see you as always. I think that our viewpoint is certainly trees don't grow to the sky. And I think a level of skepticism around, Lisa, great point made about the return on capital within AI. That for us is really the big factor. We think that with respect to technology, we are seeing that diffusion pick up. In other words, we're seeing more access to AI technologies across a broader plethora of companies, which is a good thing. At the same time, though, companies have to make money. This is about return of shareholder capital. And so you can't just have a plan where you want to spend a bunch of money on AI. There needs to be some evidence, if you will, of return. So we think that CapEx is a good guide. It's not the only guide, but we're starting to see more companies talk about those returns on their capital deployed, which for us is still a positive. So again, we're still risk on. We think consumers hang in there. We think CapEx continues. But again, we would not be surprised to see a bit of a pullback, which we'd likely be buyers of, especially as we get deeper into the doldrums, if you will, pre-Labor Day.
So you've got a pro-risk bias, quite clearly, and you've had that every time we've spoken over the last several times. What would begin to constrain that pro-risk bias for you, Eric? What could you point to specifically?
I think two things. Number one would be, Jonathan, the consumer rolls over, which we can't discount. We like to say that we have a working thesis mentality about consumers. A lot of concern about, did we see a huge pull forward in demand around the Liberation Day announcement and in the weeks shortly thereafter, and will that return? In other words, will that demand actually resurface? We have a couple of data points we can look at. Number one is back to school sales, and then number two is what we're hearing about the holiday shopping season. So we'll have some good evidence. Right now, our high frequency data checks, things like TSA data, things like open table bookings, are still very robust. So consumers are not rolling over. The second area where we could be wrong would be companies actually don't use this opportunity with a bit more tariff clarity to hire people. And again, we do think the labor market softness, it's been very well documented. That for us is a red flag. So those two elements, consumers pulling back, but then also the notion of will businesses actually come back to hire folks now that we have a little more tariff clarity? That for us would be a bit of the concerning points that would take that glass half full thesis to task relative to where we are right now.
It seems like the potential for disappointment is in the 493 based on what you just said, not necessarily the Magnificent Seven. You never said in that entire risk paradigm the idea that suddenly we're in a bubble in tech valuations and that it would crash as people lost faith in just how much artificial intelligence could actually do. Why is that not necessarily a concern for you in the same way that just sort of the more humdrum aspects of just a slowing consumer would be?
Yeah, I think that's a very thoughtful challenge, Lisa. I mean, if you look at the broader marketplace right now, and you look what's really developing from a core spend standpoint, we need to see a development beyond AI and cyber spend. That's something that is a very played out thesis. Again, we're wary of being involved for too long. I think that's something that gives us, again, some level of skepticism about the rest of the market's participation. One thing that I want to really emphasize that I think is probably undercovered is that cash flows are actually becoming more valuable. If anything, when we look at our discounted cash flow models, when we're evaluating the other 493 companies out there, there's the expectation that Fed funds goes down to 3% by the end of calendar year 2026. That's a pretty significant development. Again, that's not necessarily new news, if you will. I mean, the forward curve has that pretty well priced in. But when we're discounting cash flows, we're using a much lower interest rate, which makes those cash flows more valuable. So if anything, we think that should the Fed continue with a more measured, gradual reduction for a prolonged period of time, again, the move from 4.33 to 3% on a discount rate, that has material impacts on stock valuation. So I think if anything, Lisa, what would be another challenge, if you will, would be if the Fed decides to be more incremental. If the yield curve doesn't have that twist shape and in fact the front of the curve remains more elevated, that would make that 493 less valuable. Because we think that will likely be the outcome, the Fed will be measured but still bring front rates down. That makes the other 493 more attractive, even with more prosaic sales growth.
This is a reason why so many people are thinking that 10 a.m. on Friday Eastern time is going to be so pivotal for equity and bond markets, given the fact that potentially Fed Chair Jay Powell could come out and say, in September, we're going to cut, or in September, we're not going to cut. He's not going to say either of those things. What are you actually going to hear that will give you a sense of whether this market has baked in too many rate cuts or has gotten a little bit overly excited about the pace of the easing cycle that's ahead?
I think it is very much a horse race, Lisa, about which risk is the Fed more focused on. Again, the labor market is softening. That is something that we think has been evidenced for a couple of months, a couple of quarters, versus what about this inflation issue? Is in fact inflation going to be more ephemeral in nature? So I do think that the labor market, sort of having the lead, if you will, right now, versus a little bit of a viewpoint that perhaps the Fed is rounding down with its inflation expectations. Again, the Fed has had many opportunities to come off that 2% long-term inflation target, and they haven't budged. We do think that the Fed is actually rounding down, if you will, saying, hey, if we see something in the mid-twos, that's probably okay to start or at least to continue the rate cutting cycle. But again, I think that the terminal rate, Lisa, probably the last thing I'd say is of utmost importance to us. Again, while we are very focused on where the front of the curve may be in 2026, we also care a lot about how long it'll actually be there. The Fed has been very stealthily increasing their terminal level of Fed funds. That has material implications for equity investors like us. If we're discounting, again, a higher terminal rate, that's not a good thing. So we think that two things are really important. Number one, how long will we actually be at that terminal rate? And number two, which of those two risks is the Fed more focused on? We think that right now the labor market softness is getting a little more attention from the Fed versus inflation, which has been, again, well in their sights for some time.
Erin, let's focus on inflation. Let's just finish there. We spoke to Jim Caron and Morgan Stanley just yesterday. Now, as I ask this question, I do understand that stocks are still close to all-time highs and we're trading at a pretty elevated forward multiple. But Jim had this to say: inflation is acting like a guard dog, keeping unrestrained bullish sentiment at bay. But what if the dog doesn't bark? Then markets might be under risk. Eric, for a man with a pro-risk appetite, pro-risk bias, do you have some sympathy with those lines coming from Jim Caron and Morgan Stanley?
Oh, absolutely. I think one great imagery from Mr. Caron in terms of that visual. But I think that the inflation issue is a material risk. And again, we don't want to just whistle past this idea that perhaps inflation is going to have some normalization effect just because that's what markets currently expect. If you look at the great reporting that your team has done, companies right now are still eating inflationary pressures, not just on the goods side, but also on the services side as well. That may not persist. We could see an about face where companies say, hey, you know what, I'm in a thin margin business, and other companies are also passing through inflationary risks, so we'll do the same thing. If that actually occurs, Jonathan, then that bark may be a lot louder than we think it will. Again, we do expect, again, even just looking at differentials, look at forward estimates for inflation in the U.S. at 2.5% to 3% versus Europe and EM at sub 2% out another 12, 18 months. That's a differential that this administration, as well as companies, can't maintain indefinitely. Something has to give. Again, we do think that inflation will bend but not break, and we're a little more, I think, optimistic about inflation estimates coming down, but we certainly have to respect the case if that, of course, is wrong.
Eric, thank you, sir. Appreciate your time, as always. Eric Freedman there of US Bank. Things are pretty finely balanced going through Q3 into Q4.
Yeah, does the dog bark or bite? Does the dog not bite or bark? I'm sure I'll get it right.
The sandworms come up from below the sand.
With the shifting sands and the dog.
If you're just tuning in and you've got no idea what we're talking about, don't worry about it. Let's get you an update on stories elsewhere this morning. It's true. Let's get to your Bloomberg brief with Yahira. Hey, Yahira.
Hi, John. We are seeing Target shares plunging in the pre-market, down nearly 10% after the retailer named COO Michael Fidelki as its next CEO, sticking with a company veteran instead of bringing in fresh leadership as Wall Street had hoped. Target's results showed it continued to struggle in the second quarter with contractions in both revenue and comparable store sales. Meanwhile, sources telling Reuters that U.S. Commerce Secretary Howard Lutnick is looking into government equity stakes in Intel as well as other chip companies. The stakes will be in exchange for grants under the CHIPS Act. That piece of legislation was signed into law under the Biden administration and meant to boost domestic factory building for semiconductors. And U.S. and NATO officials are set to meet today in Washington to discuss security guarantees for Ukraine. European officials working on a plan to send French and British troops into Ukraine as part of a peace agreement with Russia. President Trump saying the U.S. would not put American troops on the ground, but could offer air support. That's your Bloomberg brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the program, fast-tracking the latest Fed pick.
The president has great sway with Leader Thun. I think that he would like to see Stephen, who I've known for a long time, get on there as soon as possible. So I'm hopeful about the September meeting.
That conversation up next with Monica Guerra of Morgan Stanley, live from New York City this morning. Good morning. equities on the S&P 500 pulling back by just 0.1% on the S&P. On the Nasdaq right now, we're shaping up as follows. On the Nasdaq 100, a little bit of underperformance once again this morning. In the bond market, we can turn to fixed income. Bond yields lower by a single basis point. The 10-year 429.65. The line of the week on the bond market, Priya Misra, JP Morgan. Sell America or the deficit, that's very April. Look at the tariff revenues that are offsetting the one big, beautiful bill. A lot of people in fixed income very much focused on just that.
It was so April to worry about duration. Now, Priya Misra and others saying, actually, maybe this is a great opportunity to buy duration, given the fact that those offsets are material. That said, what it highlights to me is just how volatile the 10-year Treasury yield has been and what this suggests in terms of its risk mitigating factors going forward.
The 10-year, just below, just sub 430, 429.84. Under surveillance this morning, fast-tracking the latest Fed pick.
The president and I are both concerned about the foundations of the Fed. How did this happen, and why did it happen, and how did the leadership let it happen? The president has great sway with Leader Thun. I think that he would like to see Stephen, who I've known for a long time, get on there as soon as possible. So I'm hopeful about the September meeting.
So here's the latest this morning. Politico reporting the White House is working through August recess to help fast-track Stephen Miron's confirmation to the Federal Reserve ahead of the September meeting. Joining us now to discuss is Monica Guerra of Morgan Stanley. Monica, good morning.
Good morning.
It's good to see you. I'm sure you saw the Politico story. How quickly do you think we can get this done?
I think you can get it done in early September, especially if leadership prioritizes it. If we're thinking about the broader legislative agenda, last time I was on, I said, maybe after, right? Maybe after we get through some appropriations bills. But now that it's the president's priority, the discussion does change. And we've seen that it materially alters the actual legislative calendar.
How do you and the team think the discussion changes on the FOMC with Stephen Miron joining the board?
I know it doesn't change September. I think that's the important thing that markets are looking at. If we're going to get a cut, we're going to get a cut. And that doesn't, alter Powell's, message to the markets. I think it's an after-the-fact issue, right? When you're thinking about the rest of the year, how deep do they go, right? And then it becomes more of a consideration.
One thing that you're so good at, given all of your experience in Washington, D.C., is understanding the cash flows of the government and how much 25 basis point rate cut actually will ease some of the current liquidity constraints that we've been talking about. We're also potentially going to be dealing with another government shutdown. Very excited for that. How much are you actually seeing a 25 basis point rate cut as materially improving the liquidity position?
Right now, we think that it's maybe going to move things marginally. One of the things that we're talking about at length is that question, right? How much, when you have a low reverse repo position as well as a draining TGA, if you're going to refill that TGA, what it means, that's the Treasury General account, that means that you're essentially taking liquidity out of the financial system. 25 basis points doesn't change a lot there from our perspective, especially if you do have a shutdown in October, which we do think is a high probability.
So this really raises a question, is that part of the calculation for why the administration could be pushing for such rapid rate cuts? I mean, can you give us a sense of what the motivation is? Is it that they expect to see some sort of deterioration in the economy? Is it just to turbocharge the economy heading into midterm elections? Or is it because there are some liquidity constraints coming down the pike that they're worried about?
So one of the things that is, I think, confusing for, our clients is that you hear, the president being upset about weak labor and jobs numbers. And then at the same time, right, he wants to have this lower tenure, so he wants a stronger labor market and a lower tenure. And those two things can sometimes be in conflict, right? Not always, but they tend to be. So it's really like, what is the motivating factor here? I think from day one, Trump has wanted a lower tenure rate. This has been a long-term goal. I think that it is just a, commitment to the broader campaign promise that they would bring that down. Now, from Besson's lens, I think you get into the technicals, right? I think you get into concerns around the financial industry and the liquidity in the market.
I think we've also got to get a deeper understanding of just what the relationship is right now between the front end and the longer end of the curve, because the president might find out pretty quickly that you can cut rates at the front end and the long end still stays elevated.
Yeah, the history book is pretty fresh from September of last year when we saw just that. So it raises a question of what's the reaction function to a potentially Trump-influenced Fed to cutting rates at the front end and seeing that sell-off at the long end.
I can understand some of the pressure to reduce interest rates if the Fed believes the neutral is somewhere around 3 and then well north of 4, then they've got space to cut interest rates. If you think they should, let's run with that. Where it could get trickier is if they see pressure to start buying bonds. Do you foresee that pressure coming around the corner down in Washington, D.C. sometime soon?
If you're thinking about, that type of pressure in the near term with the, the OBBA and all of that, when you're thinking about the actual spending, right, that is definitely on the table. But if we're looking to if we're staying in this window, right, if we're thinking about a 2-month window, there is a significant amount of potential liquidity crunch there, especially if you shut down the government and then they're not spending, right, and they are just in a sell mode.
You'd have to believe that the average maturity that's going to be issued from the Treasury is going to get shorter, not longer. When Priya was on the programme just yesterday, she was talking about where the bulk of demand is right now in fixed income, and she said it's in the belly of the curve. I think the average maturity at the moment from Treasury is something like, for everything outstanding, is something like 6 years, 72 months. You'd have to think that might even get shorter. At a time when we just spent like 5 years talking about extending gear, the incoming Treasury Secretary at the time was talking about extending gear, and you can sense that his thoughts on the matter have evolved as well since he's been in the seat.
Yeah, well, he criticized, we saw with Janet Yellen, him saying this was basically criminal. Now they're sort of doubling down on this. I mean, is this the path forward, that you're just going to see shorter and shorter maturities being sold, that we're going to be financing the U.S. government mostly in T-bills in, say, a year's time to try to avoid that kind of lock-in?
Well, what's interesting is that if you actually take that in tandem with the move from a policy lens on stablecoin, and I'm sort of throwing out, left field here, that T-bill demand is going to go up. So I think that not just from the government, back-end mechanics from the Fed and the Treasury, but also from this growing demand, there's going to be significantly more T-bill issuance.
Monica Guerra of Morgan Stanley. Monica, appreciate your time. I think a lot of people are focused on very much the same thing. All the complaining about not extending duration at Treasury, and here we are talking about spending more and issuing more T-bills.
I think that you were the one to ask him about this, and I know that you've asked him about this several times. He was pretty aggressive going against Janet Yellen about this shift. And he said, we'll market time it. If it's an appropriate time, we'll get in. And it implies that the path of travel is to a much lower neutral rate. This is actually why I'm interested to hear what they say at Jackson Hole. Are there challenges to this idea that neutral is at 3% or even lower than that? Is there a sense that it could be closer to 4%? And how much does that shift the government's ability to manufacture lower yields by just adjusting some of the maturities? Because if rates don't really ever go down substantially at the front end, well, where are you going to be?
Slightly in the weeds, but I'm sure you'll appreciate this. There is a lot of daylight between the average maturity out there at the moment and the weighted average maturity of the treasuries that are held over at the Federal Reserve. And the question I've asked is whether you start to sort of look at tightening that up just a little bit, close that daylight between the two. Not QE, but just more active management of the average maturity on the Fed's balance sheet. I wonder if that's the direction we might go in.
We've heard proposals about that with respect to some of the candidates to be on the Fed, and potentially with mortgages, how they could play more in the mortgage space to help drive down some of the rates there. Look, there are a lot of ways for them to be creative, and I'm going to get in the weeds in the sand pit with the worms on
Sandworms. What are the sandworms?
I am not going there, but I haven't even watched Dune. I'm just making up these things. I'm looking up what Arrakis was, and I'm getting very into that.
Oh, we've talked about this for 90 minutes, and you haven't even watched the movie.
Correct.
Okay, fantastic.
You have. Do you know what it's about?
Nope. I watched both too.
Okay, there you go.
Up next, Erin McLaughlin of the Conference Board with retail earnings in focus, plus Danny Berger with your morning movers taking a look at Hertz. Hi from New York City. Welcome to the program. Your opening bell is about 2 hours away. Your equity market's negative by 0.15% on the S&P 500. On the Nasdaq, the underperformance continues. We're down by 0.23. Let's get you some morning movers and cross over to Danny Berger for more. Hey, Danny.
Hey, John. A decent chunk of retailer earnings this morning. Target among them. It was another quarter of a weak sales figure and a confirmation of their view going forward of just double-digit declines for sales. And with that, underscoring the urgency of their desire to turn things around was the announcement that their COO would become the new CEO, saying in the statement that it is with urgency that he will try to build momentum for this company. Shares down 10.5%. Also, a tough set of earnings for Estée Lauder. Those shares down about 7.33%. Their outlook disappointed. They also said that they see a $100 million charge because of tariffs and that they will work to mitigate any of the tariff exposure, but still those shares sinking. Now to the upside this morning, Hertz is making a move in a big way. Those shares up 10%. The company announcing just moments ago that they will be working with Amazon Autos and selling used cars on the platform. They're going to start with a launch in 4 cities, Dallas, Houston, LA, and Seattle, cities in those places. And then they're going to expand to 45. So enthusiasm there. Those shares up more than 11.33%, John.
Danny, thank you. More from Danny in the next hour. More earnings for you, this time from TJX. Nothing earth-shattering in this one. The outlook for full year sales growth of 3%. They had seen 2 to 3. The estimate was 2.87. The stock is higher by 3%.
Yeah, a raise and a beat. I mean, that's the beat and a raise, as you've been saying. I mean, they're raising their full year guidance for both pre-tax profit margin as well as earnings per share. That's fascinating to me, the idea of pre-tax profit margin increasing at a time where we keep talking about companies eating some of the tariff costs. Very curious to see exactly why that is. Also seeing full year comp sales up 3%. They had previously seen it between 2 and 3%, and the estimate was for something less than that. Key questions will be, how are they managing their inventory? And is this a contrarian sign for the consumer, given the fact that it tends to be a more discount-oriented store? That is something that we keep watching to understand how the lower income and middle income consumers are handling prices that are increasing, and real questions about how sentiment has been faring.
The squeeze at the bottom continues. I mentioned this note from Bank of America from the BofA Institute. The difference in wage growth between higher and lower income households, the largest since February 2021. We've talked about the K-shaped economy repeatedly. Speaks to that once again.
You once said, is it a good thing when Walmart outperforms or a bad thing? It used to be a bad thing for the economy because it was considered the trade down. Now the question is, who are the bellwethers that indicate that the more business they do, the worse off people are feeling and the more they're looking for discounts? And that's actually going to be very much what we're looking for in the commentary from TJ Maxx. We've heard really conflicting messages from companies in corporate America across the spectrum. And how much does it have to do with that K-shaped economy?
If you're bearish, it's bad. If it's bad, and it's bad if it's good. That's the cheat guide for Walmart tomorrow.
Thank you.
Thank you for Sam Rowe for that one. That's always the way, isn't it?
Well, you know, my favorite, actually, Howard Marks is going to be coming up, and he said that the market is a constant battle between optimists and pessimists. And, you know, some people try to paint me as the pessimist with a pitchfork, but I will just say the contrarian view tends to be an interesting one to me.
Did they try and paint you as that, or are you quite proud of being that?
The American Gothic on the sand dune. With a sand.
I had a message from you just yesterday referring to yourself as the bear with the pitchfork.
Okay, look, let's just be honest, okay? Right now, that is the contrarian view because everyone is just so bulled up that if you are the bear with the pitchfork, you are definitely on the other side.
Howard Marks joining us in about an hour from now, so look out for that conversation. Legendary investor on this programme in the next hour. On our radar this morning, some pinning a major sell-off in big tech on a report from MIT that the AI boom may be overhyped. Researchers saying 95% of organisations are getting zero return for massive AI spending.
Okay, pause. First of all, anyone saying that this report out of MIT is the reason for the air pocket in tech stocks is really looking for reasons for the air pocket in tech stocks, because this is something that a lot of people have been talking about, including Sam Altman of OpenAI, who said there's going to be a lot of money lost. Probably some of these investments are over exuberant, but this is the path of travel when you have new technology. There was a story a week ago in the New York Times about how 8 out of 10 companies say that they're not getting any practical returns from their investment yet in artificial intelligence. So here's the question. How do you deal with the fact that this is a revolutionary change and you are going to need to be part of it, but it is not going to be an efficient pathway there because people don't even know how to use these tools yet? And that is going to be the conundrum for a lot of these companies.
It's mid-August. You know how this works. Blindfolds and throwing darts. Whenever anything happens.
Yeah, exactly. So
it's the last 24 hours.
MIT report, Palantir and OpenAI, and the question about what happened from Citron. What else do people say?
Meta spending.
Yeah, exactly.
Jackson Hole Friday, Chairman Powell, NVIDIA earnings next week.
What I ate for breakfast.
There you go. The sandworms.
All right, we got to stop. I got to watch this movie. This is absolutely dreadful.
Keep going back to that.
Yeah.
All right. The White House looking to fast-track approval of Federal Reserve Board pick Stephen Myron. Politico reporting the administration is working to shore up support with members of the Senate Banking Committee. They're still pushing to get this done for the September meeting.
And this means that if they do, Myron will be in there for just a couple months because his term would then be up, given that he is replacing the open seat. It is up in January. Question is, what would he push for? How much is this the path of travel? And are they going to try to push for other openings? Because they're trying to go aggressively after some other Fed members as well, with Lisa Cook coming under fire for other reasons, Pam Bondi going after her. A real question of how they're trying to reshape the Fed and how the Fed responds.
I think Bill Pulte trying to get Pam Bondi to go after her.
And
whether that happens or not, I've got no idea.
I mean, some of these allegations, though, we're talking about parsing the fine print of mortgages. Like, really?
I won't get into the allegations, but I will get into the fact that the Federal Reserve could be completely reshaped by this administration over the next 12 months or so. And a lot of that's going to depend on what Chairman Powell chooses to do once his term expires. Will he vacate his seat or not? And we know, based on conversations, that this is something that's really irking the White House because they want a plan. And Chair Powell has given nothing away going into 26.
Maybe we will find out at 10 a.m. Eastern time on Friday when we get that speech from Fed Chair
Oh,
Jay
you
Powell.
think it might be after this, I'm stepping aside and someone else can take control of things?
Honestly, it might be a good forum to do that if he wants to, but ultimately, I'm not expecting much.
He's got a bit more time. But you'll be there, and I'm
will.
looking forward to your coverage alongside TK. Excited for that.
The sandworms.
President Trump hosted the CEOs of the world's two biggest mining companies at the White House, the heads of Rio Tinto and BHP, discussing a major project in Arizona that they say could supply the US with a quarter of its copper demand for decades to come. I am so pleased to see this conversation taking place at the White House because we've been talking about on this program for ages.
Yeah, Resolution Copper over in Arizona. How many years has this been in process?
Years, decades.
Yeah, decades. And it's been caught up in the courts with environmental concerns, et cetera. I was looking at the details of what they actually have to do, and it looks like the copper stores in the United States that were easier to access have all been used up, right? So they were the closest ones to the surface. This is so deep in the earth that you get close to the core and it's very hot. So you have all sorts of other constraints that make it expensive. You add regulatory and environmental appeals and, oh my goodness, how does this project get done? But it shows the importance of this to the president, and it will be really interesting to see how quickly they can get this
7,000 feet, I believe.
It's
beneath the Earth's surface.
I mean, can you imagine?
It's pretty incredible.
The mechanics of that really are fascinating.
I've talked to Rio Tinto about it many times, and obviously they've been lobbying the White House to do something about this. The previous administration didn't make it happen, and I think most people are hopeful that it will this time around. This is the problem with the tariffs. Look, if you want to do something about copper, it's about regulations at home. It's not about tariffs. There are people that want to build these mines right now. They want to explore them. The deposit's there. What's holding us back here is not tariffs. It's not imported copper. What's held us back is red tape and regulation and the courts for the last decade or so.
And how do you create self-sufficiency on a mismatched timeline? Because the tariffs can come on now, but it's going to take some time to get this project really expedited.
We've talked too much. Let's turn to retail. I've talked too much.
I've talked
Target
too much
shares
too.
falling after reporting earnings and announcing its next CEO, longtime executive Michael Fidalke, is going to be taking over. Jen Partashis of Bloomberg Intelligence joins us now for more. Jen, welcome to the show. I think we've got to start with a C-suite change. What is behind the change, and what's at the top of the to-do list for the new CEO?
Good morning, and thanks for having me. When we look at the CEO change, really, I think that there was investor appetite for sure in having a CEO change. You know, Brian Cornell's been at the helm for 11 years. When he first came in, it was a visionary. Target took a whole new growth path under his leadership and stewardship. But I think the change announced this morning with Michael Fidalke coming in from COO up to the CEO role sort of implies that there's likely to be a continuation of the existing strategy, and that may be what's part of contributing to the slide in the stock this morning. I think there may have been expectations that you need someone with an external vision or with a different vision to really kind of right the ship the Target is.
That's something Lisa talked about, Jen, as the numbers were dropping and we saw the decision cross as well, that maybe that was the disappointment. Jen, what have they been struggling to do? And is this down to the changes we've seen, the competitive effort that's come from elsewhere, from the likes of Walmart?
Well, I think a lot of this started with coming out of the pandemic and with the consumer shift to more essentials in a period of very high inflation, especially for food, where people were making decisions about how they were spending their money. Target is over-indexed in discretionary spending categories. So they're famous for their fashion, for their home decor, for baby and things like that. And as people moved towards more essentials, that really left a gap for Target, where they had to try to figure out what they were going to do. The company's done a very good job in terms of continuing to keep their private label selection fresh and that sort of thing, but the consumer just hasn't followed track. And when you layer in on top of that some of the corporate decisions that have not resonated with their core base, like with DEI initiatives and things like that, it's just been a rough time for Target lately.
They've had a really difficult time of it. Jen, thank you. Jen Bartash there of Bloomberg with the latest. I want to stick on the consumer. We want to. Erin McLaughlin of the Conference Board writing this. Consumer confidence has stabilised since May, but tariffs remain top of mind with concerns that they would lead to higher prices. Erin joins us now for more. Erin, good morning.
Good morning.
Is there some evidence that maybe these companies aren't able to pass on these higher prices because consumers right now just don't feel good?
Well, that's a great question. Consumers are definitely burnt out still. They have, post-PSTD from the COVID era, but we think that companies will probably have no choice but to pass them on. We're looking at the import index, which is monitoring the prices that are paid when imports come into the ports. They're not going down. So these goods are not being paid for by the exporters, by companies in other countries. And so it is a matter of time before the price hikes really do reach consumers, but they will get there.
Consumer confidence has been something of a roller coaster this year. It seems like we just are seeing the ups and downs of the headlines and how they filter in. How do you get some sort of compass for what the lasting sentiment hit could be when you juggle both the potential inflationary impacts of tariffs with a labor market that isn't great, but it's not terrible?
Right. I think it really will be down to how consumers feel when they buy non-discretionary goods on a regular basis. Obviously, there has been a little bit of a roller coaster, but consumers are often reacting to the news in addition to reacting to what they're seeing at the grocery store and at other stores. So even though there has been a little bit of a roller coaster, it is within about the same range. It's still, not as low as it was in April, on the Liberation Day announcements, but it is up from what it was in April.
One thing that you do a great job of is look at the confidence that people have that they'll be getting jobs or that they'll be able to retain their jobs.
Yes.
And does anything that you're seeing in those surveys reflect the negativity that a lot of people saw in non-farm payrolls and some of the revisions that really spooked this market in a significant way at the start of this month?
We are not seeing huge negativity. Obviously, unemployment is still at a very, very low rate. Most folks that are taking the survey, they might say 1 month to another that it's a little bit more challenging, but that there's less jobs out there. But it hasn't seemed to have a huge impact on overall consumer sentiment yet.
What's the spread like between Republicans and Democrats? And how do you filter some of that? Because you, Mitch is nuts. When I looked at that at the end of last week, the spread was like this wide. Ask a Democrat how the economy is right now. They're in depression. Ask a Republican, best economy ever. How do you filter that out?
We don't necessarily filter it out per se. In our index, it's interesting to see that the movement is about the same from month to month. So Democrats definitely feel more negative and are saying that they feel the impact more than Republicans. And then we also look at independents as well. And so they are sort of moving at about the same, and there isn't as wide a gap as one might think.
Some of these surveys, not yours, this one survey, you, Mitch, that right now is a political poll. That is not a consumer confidence survey for the economy, at least in my opinion, and I think for Wall Street too. That's got to be the way a lot of people have started to look at that survey coming out of Michigan.
Yeah, although, what did Michael Jordan say? Republicans buy sneakers too?
Yeah, say it all the time.
Democrats buy sneakers too as well. So how much does this really translate into reality, or how much can we actually look at any of these surveys and just say some are more meaningful, maybe, than others?
We like yours. The labour differential. The labour differential is super useful, I think.
Totally.
Super useful. Erin, it's good to see you. Thank you.
Thank you.
Thanks for being here. Erin McLaughlin there of the Conference Board. Let's get you an update on stories elsewhere with your Bloomberg brief. Here is Yahira. Hey, Yahira.
Hi, John. We start with TJ Maxx, and it is a different story than Target. Shares are trading higher 3.6% after reporting a beat on Q2 results. The discount retailer is raising its full-year guidance for both pre-tax profit margin as well as earnings per share. The CEO saying transactions were up at every division and saw strong demand at each domestic and international business. Meanwhile, Trump ally Bill Plute, who is director of the Federal Housing Finance Agency, has called on Attorney General Pam Bondi to investigate Fed Governor Lisa Cook. Plute alleges Cook, quote, falsified bank documents and property records to acquire more favorable loan terms, potentially committing mortgage fraud. Cook did not respond to requests for comment from Bloomberg. And a 6-seater variant of Tesla's Model Y will not be coming to the U.S. market this year. According to a post on X from Elon Musk, U.S. production of the vehicle will not begin until the end of next year at the earliest, or quote, not ever, citing self-driving developments here in the U.S. The vehicle was recently launched in China. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, comfortable with the status quo.
China is right now the biggest revenue line in the tariff income. So, if it's not broke, don't fix it. They have started shipping the rare earth magnets, which we agreed to. Right now, the status quo is working pretty well.
Up next on the program, we'll catch up with the former Biden economic advisor, Greta Peisch. She joins us next from New York. This is Bloomberg. Equities pulling back by 0.2%. The latest from TJX and the retailers in America. 3Q off to a strong start. Off-price retailers are going to do okay in this environment. How many times have you heard that line over the past few months?
Is that a good sign or a bad sign for the U.S. economy, given the fact that spending should be a positive sign, and yet if people are looking for discounts, does that mean that people are trading down and concerned about what's to come?
Beat raise and a strong guide from that company. Stocks are doing just okay. Under surveillance this morning, comfortable with the status quo.
China is right now the biggest revenue line in the tariff income. So, if it's not broke, don't fix it. We have had very good talks with China. I imagine we'll be seeing them again before November. They have started shipping the rare earth magnets, which we agreed to. Right now, the status quo is working pretty well.
So here's the latest this morning. The Treasury Secretary Scott Bessent saying the U.S. is content with its current trade status with China. These sides now have until November to strike a new deal. The former Biden trade advisor, Greta Peisch, writing the following. Negotiations will continue to implement whatever understanding was struck with the administration. Those deals may result in exempting certain products from tariffs in partner countries or look at inputs from China. Greta joins us now for more. Greta, good morning and welcome to the program. Your profession relies on documents, and we can't find the documents for these agreements with these countries. How does the legal profession work without documents?
Right. Well, that's exactly right. Statements from the administration, including the president, are not agreements, and they do not have legal effects. So we take the announcements that come with a grain of salt until we see what's actually implemented. And what you're seeing with negotiations with trading partners is that it may take some time to have a final conclusion spelling out what these handshake deal terms are and ensuring that there's a meeting of the minds. The devil is in the details, and I think we're seeing that play out in the amount of time it is taking to finalize, implement, and announce these agreements.
Given that, Greta, how do you advise clients? How do you advise companies on how to understand some of the agreements that have been put in place, at least in theory, but where the details haven't really been fully exposed? And I'm speaking specifically when it comes to the biggest trading partner with the United States, which is China.
Right. Well, what we're seeing with the agreement with China is really a holding pattern, a stabilization, if you will. You heard Secretary Bessent say, we like where it is right now. And I think that that's what we're seeing in the continued pausing, the continued extension of the agreement that we have in place. The relationship was pretty rocky. We saw the tariffs go up quite a bit. We saw China's export controls. And what we've seen is a pullback from both sides, an attempt to at least right the ship and have a bit of stability on both sides. And it seems like that's where they are for now. And until we see further action. I think that that's where companies and where other trading partners should see that relationship, at least for the time being.
It was pretty striking to hear Scott Bessent, Treasury Secretary, come out and say that actually the status quo that they currently have with China is working pretty well. It raises this issue of whether this is just making nice ahead of some sort of summit between Xi Jinping and President Trump, or whether this is something that really speaks to the desire for revenues from these tariffs more than, say, national security or any other kinds of measures. Is that your takeaway from this?
Well, I think a challenge with the China negotiations, as well as with other negotiations and the trade policies overall, is nailing down what the administration's bottom line objectives are. And they do have a variety that have been expressed, including raising revenue, including bringing manufacturing back, including securing supply chains when you're talking about our trade with China. And so understanding what is that end game? What is the mix of policy objectives that they're prioritizing? You can't necessarily achieve everything, and you can't have every competing objective be your first priority. And so part of it is understanding and trying to see from the administration, from their statements and from their outcomes of what does success look like when they're talking about their trade policy? Where do they want things to be in a year? Is it all about the revenue? Is it about other policy objectives, from supply chains to manufacturing to getting concessions from trading partners?
Well, let's talk about national security. As you know, a number of 232 investigations are still pending. And for people who don't follow the numbers like you do and the names, that's an effort to look at specific products that might impair national security. Now, Greta, I just wonder where you think this is all going to land, and whether you think the decision on these investigations might be tied to the outcome of the legal challenges to the tariffs that have already been implemented.
Well, I do see them as a bit separate, right? The challenges to existing tariffs, that's under a separate authority. You're right. There's an alphabet soup of and many numbers in the different authorities, right? And so those are the legal challenges now are to the countrywide broad tariffs that are in place that are the basis for the negotiations. The 232 tariffs are sectoral, and those investigations, many of which are still outstanding, really are related to areas that do have supply chain vulnerabilities, and where even the last administration looked at some of the concerns. So this is critical minerals, it's semiconductors, and so those are, I view on a separate track that are really about trying to find maybe a policy that is addressing those supply chain concerns, trying to reshore or nearshore some of the supply chains, and that they're on a separate track.
Greta, no doubt we'll talk to you again soon once we see the outcome of those pending investigations. Greta Peisch there. Thank you. Up next on the program, Alicia Levine of BNY Wealth, Deborah Weinswig of Coresight Research, Howard Marks of Oaktree Capital Management. 45 minutes away.
If the inflation data continues to be held back by lower energy prices, it all softens the economic blow.
There should be a pullback in demand. We haven't seen it yet.
The consumer slows down, but the rate of change of inflation will jump.
Those that had the capability brought a lot of inventory, and going through that level of inventory has not yielded the pass-through to consumers that some have seen, but it'll come.
Ultimately, I do think that we're going to see more softness in the second half on activity.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now. The opening bell is about 90 minutes away. Your scores look like this. Equity futures down again, just softer by 0.1% through most of this morning on the S&P. Big tech in focus. Bit of a downdraft in yesterday's session. The Nasdaq 100 down by 0.2% so far this morning in today's session. I want to take a little look at the consumer in America, though. Let's just take a snapshot of some of the news we've heard in the last 24 hours. Target's got its own problems, down 10%, big management change. But go through the names. Home Depot consumers tapping the brakes. Off-price retailer TJX attracting consumers. McDonald's pressuring franchise owners to drop prices. It doesn't scream that everything's flying off the shelves right now.
If you have an increasing focus on value at corporate America, what does that say about the level of consumer spending and how sustainable it is for consumers? A real question about just the fragility there. And that's what you're hearing in some of these reports. We're dealing with a nuanced backdrop and a consumer that's increasingly discretionary. And that's the reason why a TJX beat and raise isn't necessarily a positive sign for the consumer going forward.
This is the basic, simple argument from the doves on the FOMC right now. I imagine it goes something like this. We meet in the middle of September. We know we've had a step down in jobs growth. We're at something like 4.5% on Fed funds. We all think neutral. We can agree is somewhere between 3.50. Some of you crazies out there think it's higher. I'm being a dove on the FOMC right now.
I hear you.
Let's cut rates by 25 basis points and then get to the next one. I think that's the argument for the doves on the FOMC.
And somebody, if that was the raging hawk on the FOMC, could push back and say these companies are still outperforming. TJ Maxx actually is expecting its margins to expand more than expected. You're seeing the likes of Lowe's make an acquisition with greater confidence that we might be at some sort of bottom of the housing cycle. All of a sudden, if you do start cutting rates, how much do consumers feel better about things to go up the chain, buy more, and accept more of those price increases?
Then Governor Waller just starts throwing things at you across the table.
This is going to be fun.
There was a big push for a live feed at the last meeting.
I know, I saw that.
I'd take the live feed once, just to see how boring it actually is.
That's what I was going to say.
So I imagine it's pretty boring.
I imagine this is C-SPAN stuff. I mean, maybe with some side conversations that are a little more spicy.
Aggressive, like C-SPAN on steroids. Like
how
sheets
could
of paper.
you say that? I think
sheets of paper.
Yeah, exactly. Yeah. I mean, look, I don't think it's exactly guns a-blazing. I do think it's going to be more heated this time around, especially given how bifurcated the economic views are on Wall Street.
I'd like to see Stephen Myron there. That would be more exciting.
I think President Trump would also like to
That's
see him there.
That's a better kind of C-SPAN.
Well, I think that you might
Then it gets entertaining.
Yeah, you think so?
Yeah, of course it does.
Yeah, maybe. I mean, look, a lot of people say that this is the big problem is groupthink, and how do you avoid that? And maybe it's putting Stephen Myron on the board.
I think we've already got some healthy dissent taking place, some healthy division taking place on the FOMC going into this. Now, whether the president had a role to play in all of that, I don't know, but I think you can see it in the speeches. There is some division between these guys right now. I think that's a good thing.
What you can see in the earnings from corporate America is also some division and disagreement exactly how strong or weak things are. This is a confusing moment. That's why we're talking about sandworms, because ultimately I can't give you the answer, but we can see different companies trying to take advantage of the pockets of strength that there are still out there.
Would you like to explain why we're talking about sandworms? Would you like to take the opportunity?
Sure. Because I've actually done some research on Dune, and I actually would like to see it now because I really think that this idea of that drug that you can take to make you, live longer and travel through space sounds great. But I do think, just let's put that aside for a second. I was saying this is the year of shifting sands. And then John brought us to sandworms.
Have you done that much reading during this program this morning? You're doing that in the conversations or the commercial break?
Let's just move on.
Okay,
coming up. Commercial breaks.
This hour, sure. Alicia Levine of BNY Wealth as the tech sell-off drags down Wall Street. The brilliant Howard Marks of Oaktree Capital Management on why markets are turning from elevated to potentially worrisome. And Seema Shah of Principal Asset Management as investors look to Jackson Hole. We begin this hour with stocks down following a sell-off in big tech. Alicia Levine of BNY Wealth writing the volatility in tech is likely to continue into the Fed meeting and can pull the overall index down in a seasonally weak part of the calendar. Alicia joins us now for more. Alicia, good morning.
Good morning.
Got to start with the tough one. What was the last 24 hours about?
I think it was the air pocket of August and just the fact, NASDAQ is up 56% going into yesterday from the April 8 lows, and then S&P is up 34%. It's the most torrid rally in history from the lows. The return to the old high was 55 days. That beat out 1998 in terms of the speed of it. So time for a breather. Everybody was piled into the same trade. And, everybody's on the last 2 weeks of August. People are on vacation. And so, you've got junior people in charge of the trading desk. So
and now the junior people in charge are now asking a similar question that even the senior people have been asking. Every time you have some outperformance in the equal weight, can that rotation continue? Does it have legs?
It's heavily dependent, obviously, on rate cuts. So the market's pricing in rate cuts. We think the Fed's going to deliver the rate cut in September. I would say, obviously, Jackson Hole's the one time to change the conversation. But since rate hikes have been off the table, we're headed towards, a cut one way or the other. the rotation, the equally weighted index needs a series of cuts. And when you get one cut, you don't get one, you get several, at least another. So that means 50 basis points at some point by the end of the year, not just 25. That would be positive for risk assets in general. And as you point out, the data have been at odds with each other and confusing. And the real economy starts to look weaker in the labor market. Labor market is looking a little bit softer. Consumers looking a little bit more bifurcated from the high end and the low end. So hikes are off the table. It's actually a great setup for risk assets. I have a colleague who works in the fixed income area, and he's always like, great time to buy equities. And yes, it is a great time to buy equities when earnings are moving higher, right? Earnings are moving higher, and the Fed is cutting into that. And not yet in a under 1% growth world. That's pretty bullish for the next 12 to 18 months. That doesn't mean you can't sell off 10% here. You easily can sell off 10% here just to get the excess out.
I love it. You say that, he says, great time to buy stocks. That's what everybody thinks. The reason why we've not seen a 1% drawdown since August 1st, and it's the biggest drawdown going back to April. And I just wonder, does this suggest that there is some nervousness around valuations, particularly with big tech? Or do you think that people are sort of missing the forest for the trees when it comes to missing the trees for the forest when it comes to looking forward? I can't get anything right. Stop laughing at me.
I'm not laughing.
You are laughing right there.
No, we did the horse and the cart yesterday, and you and I messaged each other about it last night.
I can't get any expression. Okay, see the trees for the forest. Let's just move on. Look, stop telling me, control room. I know I'm doing it wrong. Pause. Reverse. How much are people getting it wrong that big tech is the most overvalued part of the market?
So we don't think big tech is overvalued. The issue is the rest of the index is struggling to keep up on the earnings side. So all the earnings are coming from tech, pulling the index upward. So the top 10 are now 40% of the index, 30% of the earnings. That's not as extreme as in history, but that's where the earnings are going. So not as vulnerable as previous periods, but overall on the index level, absolutely. You know, NVIDIA earnings next week are going to matter because the investment in AI is pushing the economy. I mean, the CapEx from all these hyperscalers is about $370 billion this year. That is equal to the hit from tariffs, which is a tax of about $370 billion. They're canceling each other out, keeping the economy, you know, in equilibrium here. That investment is driving growth in other parts of the economy, the industrials and utilities as well. It matters a lot. So the earnings for NVIDIA matter a lot.
So are we being too cute when we say that the MIT report talking about how 95% of investment in AI from corporations has not been profitable, that's just an excuse for this air pocket? Or do you think that there is something real there?
Look, there's definitely concern because the free cash flow margin has dropped this quarter and the second quarter because of the massive CapEx spend. We don't think this is the place we're going to wind up. But you have to believe the payout is there. If you run some models, you're getting paid to wait to see if the theory is correct. We will say this, the implementation of AI throughout the economy is going to drive a massive productivity boom. And that's why we're still investors in equities, because we think it's going to drive throughout the economy. It doesn't mean you can't have a transition phase where earnings are a little bit squishy because the investment is so high in the most obvious part of the market could drive the index lower. But we just raised our earnings estimates for 2025 and 2026. We put a 6,700 price target on the S&P for the end of the year at BNY Wealth, and we introduced our 7,500 price target for 2026 because earnings are simply moving higher. In the end, there's the real economy, very conflicted there, some squishy parts of the market. Clearly, the lower end consumer is under stress. The labor market equilibrium number is now lower, probably in the 50 to 70,000 jobs per month. No room for error. On the other hand, earnings are moving higher. So corporate America and large cap corporate America is able to power through it. The real economy is not the stock market.
This is the question for Chairman Powell, I think, going into Friday. Is he focused on the demand side or the supply side of what's happening in the labour market? An emphasis in a speech is always important. If he puts more emphasis on one versus the other, the market's going to read a lot into that about what to expect for September and beyond.
It basically lowers the threshold for just what kind of headline numbers there actually have to be if he emphasizes the demand side and not the supply side. If he says this is something more than just an immigration story and how many workers there is actual weakness in this low hire, low fire market, suddenly that payrolls report of 35,000 people becomes a lot more concerning.
Have you heard the story about the cart full of sticks and carrots pulled by the horse through the forest? I'll tell you that story another time. It's a fascinating one. Alicia, thank you.
You're killing me.
Alicia Levine, why?
I'll take classes.
You've got to put the 2 days together to really understand what's been going on.
I can't get expressions right. I'm going to have a tutorial.
But I enjoy that you try. I can't either, so I just don't bother. So I'd love to help you, but I don't know what you're talking about.
We'll get cheat sheets.
I know. All right, OK. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. The White House is fast-tracking Stephen Miron's confirmation to the Federal Reserve to put him in place ahead of the FOMC September meeting. Politico reports Miron has been meeting with members of the Senate Banking Committee to greenlight his nomination ahead of the full Senate confirmation vote. The Senate is in recess until September 2nd. Meanwhile, Federal Reserve Governor Michelle Bowman said banks and regulators need to embrace new technologies such as AI and crypto or risk their role in the economy. Speaking to our own Mike McKee yesterday, she said she would seek to cut down regulatory scrutiny tied to reputational risk, suggesting new rules could be made. Bowman has emerged as a potential replacement for Fed Chair Jay Powell at the end of his term. And Real Madrid secured a win in their opening La Liga game of the season, defeating Osasuna 1-0. The star of Madrid, Kylian Mbappe, converted a 51st-minute penalty kick to give his team the victory in yesterday's Spanish League opener. That's your Bloomberg Brief. John?
Yahira, thank you. Thank you very much. I was going through the injury list over at Real Madrid. That squad is absolutely absurd. Just some of the world's best players just out injured, and they can still put out an 11 that's just to die for.
Yeah, which just shows you how good their roster is. It also shows how hard they're being played. I mean, the number of games that they have to play, I just can't get over that.
I'm with you. To have a world-class squad right now, you need ridiculous depth to get through the average season for a top club now.
Yeah,
it's nonsense.
Depth of the pocketbook as well, which is the reason why.
Greed, Bramo. Greed of FIFA and UEFA of pushing this whole thing too far.
Yeah.
But it's a conversation for another time. I'm always shocked by the baseball schedule. I just think it's insane, the amount of games they have to play every single year.
Yeah, the number of games I have to hear about every single night at
Don't
home.
you think it takes something away from the games that you actually get to see, though? Like, let's say Yankees-Red Sox happen twice a season, home away. Like, that would be amazing, right?
What's that? You really hate that?
Instead of like
why is he talking about that?
50 times.
I'm sorry, I'll tell him to stop.
Is that the kids at home?
Yeah, exactly.
They want that.
They want
game.
as many games as you possibly
Okay.
can have, because it also democratizes the games, and they're great, in terms of being
tickets
able to have the
cheaper?
access. Tickets are cheaper.
Okay.
You can go. The American sport, pastime.
Not trying to ruin it. Just my view on things. All right. Up next, the Morning Calls Plus, Deborah Weinswig of Coresight Research with target shares down and a new CEO coming in.
It is our expectation at Nomura that the Fed will cut in September and December. But even if they cut in September, it's then not going to necessarily be a slam dunk that there'll be a December cut. You have to look at, well, do we see signs of tariff-induced inflation coming? There's a lot of new information that we're going to get from the September 5th and September 11th labor market and inflation reports that we just don't have right now. And both of those reports come before the next Fed meeting.
That's David Seif of Nomura weighing in on the situation with the Federal Reserve. The calendar shaping up as follows. Payrolls on September 5th. A week later, we'll get CPI, and then a week after that, a Federal Reserve meeting. Equity futures on the S&P down by 0.1%. On the Nasdaq, we're down by 0.2. That's the price action this morning. Here are the morning calls. First up, Wells Fargo raising its price target on Home Depot to $450, saying category sentiment should improve. Your second call from Citi, downgrading Gap to neutral, saying specialty retailers are going to be challenged by tariffs. And finally, JP Morgan downgrading General Mills to underweight, writing the current environment is challenging for food producers. Let's stick with retail. Investors looking for signs of inflation in retail earnings ahead of comments from Fed Chair Jay Powell in Jackson Hole on Friday. Bloomberg's Mike McKee joins us now for more. Good morning, Mike.
Good morning, John. Well, we've seen some indications that there are price effects going through. Home Depot, most notably yesterday, talking about that. The real question is, how much do they have in inventory that they can sell at lower prices before they have to start raising them? We've heard from a number of consumer product companies that they're planning in September or October to start raising prices. So how much of a pass-through do we get in August that would show up in that September 11th report? That's going to be very interesting for the Fed. It may not be the bottom line number in terms of what year-over-year inflation is. It may be the underlying inflation indications of what's coming down the pike.
Mike McKee, just before you go, we're all looking forward to your coverage in Jackson Hole, but I wanted to take a beat. There was a man, they don't make hawks like this for sure anymore, Charlie Plosser, a gentleman that you know well. I had the privilege of speaking to on occasion. Confirmation in the last 24 hours that Charles Plosser passed away peacefully on Thursday, August 14th, at the Warner Community Hospice in Amelia Island, Florida. We knew him well as the Philadelphia Fed president, Michael, and that was a man who had his hawkish beliefs and stood by them. And I can only imagine what his voice would sound like on the FOMC in mid-September.
Well, I saw Charlie in July, and his voice was the same as ever, that the Fed had gone too far, that it needed to start dialing back its accommodation, and that it needed to start move faster to bring down the balance sheet, because Charlie was an old monetarist. He believed that too many dollars chase too few goods and you get inflation, and there were a lot of dollars in the market. So yes, Charlie would have been a firm vote for Fed rate hold, or if the numbers come in a little hotter, or even a rate increase these days.
Mike McKee, looking forward to your coverage. Just a thought there on the late, great Charlie Plosser on the Federal Reserve. They were the days, weren't they? 10 years ago?
You didn't have groupthink. And
Absolutely
he was very
not.
much somebody who would have pushed back against some of the main belief right now that the Fed should start a real aggressive rate cutting cycle.
Alongside, what was it, Richard Fisher?
Yeah,
at the time?
Yeah,
Someone you really enjoyed. Right?
Such great essays. Fantastic.
Yeah. Different time. Where are those hawks on this Federal Reserve?
And do we need them?
Good point.
At a time of real political pressure.
That's the story for later on in the week. Let's stick with the consumer. Target warning shoppers remain selective in their spending. Coresight Research CEO Deborah Weinswig writing Target is under pressure. Discretionary categories remain weak. Traffic is down. And tariff exposure plus digital reliability concerns add to challenges. Deborah joins us now for more. Deborah, welcome to the programme. Do you believe, and just to sort of reflect on what we've heard from Target and other retailers, whether that's just a problem specific to them or whether it speaks to maybe a consumer under some increased pressure?
Well, first of all, thanks for having me on the show. And to answer your question, I think it's really a tale of two retailers, say, if we look at TJ Maxx and Target. So both are off mall. And so really, truly a direct comparison. One saw Thompson, the positive territory, and one very much in the other direction, which was Target. And so I think that going back to kind of the tariff conversation where Target is very much vertically integrated, right? They sell a lot of their own product. There's no vendors to kind of push back on. Target's probably seeing, kind of pricing pressure and margin pressure that TJ Maxx isn't. But I think there's also a lot of execution issues that they're facing as well.
Can you give us a sense of what those are, Deborah? Because right now it seems like the market is responding to this prospect of more of the same when they were hoping for maybe a fresh look at some of the management of the company.
Great question. And I will say I'm very much in that camp. We've been very critical, I would say, at Coresight of their in-store kind of on-shelf availability, right? If it's not on the shelf, the customer can't buy it. So when supply chain as basic as that is not able to be executed, there are concerns kind of throughout. Also, their digital, kind of sales have been much weaker versus, I think it was like up a little over 4% for the quarter versus their peers. And as other retailers are able to leverage other sources of, whether it's data monetization, retail media, retail as a service, but Target is missing the mark there. And I do worry that not bringing in kind of outside talent is going to be more of the same.
Deborah, how much, when you just expand out to the broader retail industry, how much are all of these companies sort of an execution by execution story at a time with a pretty complicated economy and, frankly, a pretty discerning consumer?
Great question. If you look across the bow, if you will, I mean, Walmart, despite its size, right, has seen really, from an execution standpoint, high on-shelf availability, ways to monetize not just in store or not just merchandise. They've also continued to elevate their leadership team and bring in fresh talent, very much focused on AI and how that can not only drive sales and execution kind of on the digital self, but also in the physical stores. And so I think you've got the shareholder, kind of your sales associate behind you to really drive that execution every day. And I just think when you look at Target, they haven't been able to do that. Expanding that over to specialty retail, or let's call it, mall retail, we've really seen unbelievable execution. I think a lot of it is how the malls or the mall REITs and the retailers in those malls have really started to kind of partner together on execution. And I think that there is going to be a bigger story here of the haves and the have-nots. This isn't based on income levels, although that's certainly a part of the story. It's really based on execution.
So, Deborah, there was a lot to unpack there. Just picking up on one point, how much are you going to hear, who do you expect to be the winner in sort of the use of technology in retail to gain efficiency at a time where there are a lot of questions about just how much people are doing that? Who do you think is going to win?
I mean, right now it's Walmart. And I will tell you, that is not at all what I would have expected to come out of my mouth a year ago, just based on size and the complexity that you would need to hit fire on all cylinders based on that. I would have expected to see more one of the specialty retailers. But we've really seen, if you look across, it's been kind of like a Walmart, a Home Depot, a Tractor Supply. It's been these bigger off-mall retailers for the most part. And it really has just been this kind of intense focus on execution and leaning into technology, specifically Gen AI. And I think that's going to, right, that's really just accelerating their growth. And also, I actually think the bigger thing here is it's allowing them to attract best-in-class talent. We're hearing that, kind of best-in-class data scientists these days are going to Walmart. They're not going to Amazon, right? They want to have this physical presence. They want to be able to kind of, there's a pride that's taking place there. I think it's unlike anything we would have expected.
Yeah. Deborah Weinswig there of Coresight Research. Deborah, thank you. You've talked about this so many times with regards to Walmart.
You can say whatever you want about where the profitability is. The investment is actually, in some places, paying off.
Up next on the program, the brilliant Howard Marks of Oaktree Capital. From New York, this is Bloomberg. The opening pound's about 60 minutes away. Equity futures are negative by 0.1% on the S&P. We're down by 0.25 on the Nasdaq. Let's get you some morning movers and cross over to Danny Berger for more. Hey, Danny.
Hey, John. It's a tale of two retailers. For one, really solid results from TJ Maxx and an outlook that was better than expected. Those shares up 3.8% this morning, but some of the more value-oriented type retailers outperforming. Contrast that with what we got from Target. Target shares are plunging in the pre-market trade this morning. They are down by 10.33%. It was another weak quarter of sales, also reaffirming their outlook of low single-digit declines when it comes to sales. Also announcing the COO would become the CEO, saying in a statement that he is addressing matters with urgency to try to rebuild momentum. Finally, wrapping things up here with a Reuters report that Howard Lutnick is looking at other companies reportedly that have received money through the CHIPS Act and maybe taking a stake in them. You can see the negative reaction. For one, Intel falling this morning. We already know about what the government plans to do there too. But the other two biggest recipients of the CHIPS Act are Micron and Taiwan Semiconductor. So those shares falling 5% and 1% respectively, John.
Danny, thank you. How is this going to work? Huge focus for us over the next, never mind several months, several years.
How do you have a grant that gets transferred into a stake, an equity stake that's non-voting for now? And this is the reason why we got lost down a rabbit hole. I'm not going to go there about shifting sands, but it's this whole idea of how do you understand what the framework is going forward? If there is such a fungible quality to grants that have already been guaranteed and exactly what form they will take going forward.
What a moment for that industry. What a moment for this market. What a moment for us. Legendary investor Howard Marks of Oaktree Capital Management releasing a new memo called The Calculus of Value, writing overvaluation can never be proved and there's no reason to think there will be a correction anytime soon. But the stock market has moved from elevated to worrisome. I'm very pleased to say that joining us on this programme, Howard Marks joins us for more. Howard, welcome to the programme, sir. We want to start with a central question that you pose yourself. Why are asset prices so strong in the face of what you view as net negative developments? Howard, can you share your thoughts with us?
I'm glad to be with you this morning. Of course, as the quote you just put on the screen indicates, this is all just feeling and an opinion. None of this is factual, but it does seem that stocks are expensive relative to what I call fundamentals, or you might call reality. And the outstanding reason, I think, is that there hasn't been a serious market correction in 16 years. So people get out of the habit of thinking about market corrections. The biggest single mistake, I've been thinking a lot, what is the biggest single mistake investors make? And I've concluded that it is that they conclude that the way things are today is the way it'll always be, and the things that have been happening will always continue to happen, whereas reversion to the mean is much more likely. So I just think that it's worked very well. Being an equity investor has worked very well. Doing it on leverage has worked even better. Concentrating in a few stocks has gone very well. Investors are by nature optimistic, and that optimism dies hard. I just think that the fluctuations of the market are mostly related to psychological fluctuations, and people go from neutrality to liking stocks, to liking them a lot, to liking them a ton, to liking them too much. And that's the continuation that creates bubbles. And, we're probably in the early days of that.
When you talk about liking, Howard, maybe liking these assets a little bit too much, can you put into perspective the last time you saw this type of environment that left you thinking maybe some of the opportunities aren't as great when it comes to buying some of these assets at current valuations? Is there another time that this sort of reminds you of in any capacity?
Well, I guess, Lisa, the last time was probably around 97, when the market was kind of falling in love with tech stocks, and the market was rocketing along. People were not worried about the level of valuations. People were extremely optimistic about the opportunities for the internet, Alan Greenspan famously cautioned that there might be irrational exuberance. Now I picked 97 because even though Greenspan was concerned about exuberance, the market went on to rise for another 2.5 to 3 years. So remember, I said we're in the early days. We're not at a critical, at a nutty valuation. I'm certainly not ringing the alarm bells, as the quote that you had on the screen said. No reason to think there'll be a correction soon. But the point is that things are expensive. They may go on to become more expensive, but the fact that they're expensive, it should not be lost.
And Howard, I think a lot of people point to, in terms of the echoes of the late 90s, the tech sector of the market as being the most overvalued. What I thought was so interesting about your memo is that wasn't your take, that wasn't your bigger concern in the market at a time when people are counting on a certain robustness of growth and a certain kind of inflationary backdrop. Why is it that tech isn't the focus of your concern this time around?
Tech contributes to the aura that surrounds the markets. And a lot of people have been citing the fact that the so-called Magnificent Seven, stocks like Amazon and Alphabet have been contributing disproportionately to the rise, and they're responsible for more than 7 stocks. Their dollar gains have been responsible for more than half of all the gains in the 500 stocks in the S&P, 7 out of 500. But they're great companies. They're at high valuations. I think that I can't say those valuations are excessive. But the other 493 stocks are quite highly valued, not as highly as the Magnificent Seven, but nobody says they're the same quality company, quite highly valued relative to history. And it is the fact that high valuations are being applied to more average companies that I think's more alarming than the fact that exceptional valuations are being applied to exceptional companies.
Howard, there's a quote you use in this memo. I enjoyed this quote. You said, "He who knows only his side, his own side of the case, knows little of that." And then I worked through the rest of the memo, and there was a conclusion there about credit. And I just wonder, sir, whether your focus on equities in this note offers you a greater perspective on how much value is offered in credit right now.
Well, it's as John Stuart Mill said, and I believe it was 1859. You have to know all the sides of the story to understand whether your side holds water. And I cite the bull case there for why the market isn't overvalued. I think that's part of the job. But as you say, my conclusion is that I'm not, as I said before, I'm not raising an alarm bell, but I do think it's time for some caution. And this is a little bit of what we call on Wall Street talking your own book. But what I do, what Oaktree does, is mostly something called credit, buying the debts of companies, and debt is inherently more defensive than equities. And you have a promise of payment. You know what your return will be if they pay interest and principal as promised, and most of the time they do. So I just think that this is a time to put a little more defense into your portfolio, and investing in credit as opposed to equities is one way to do it.
Is it still defensive, Howard, if you're looking at credit spreads that are the tightest since 1998? I'm looking at investment-grade credit spreads, which are thought to be a more defensive part of the credit market. I mean, does that sort of question what it means for it to be defensive when the valuations are high there as well?
Well, first of all, Lisa, debt or fixed income or bonds or what I call credit, all different words for the same thing, is different in nature from equities because you do have a promised contractual rate of return. And you can say that the promised contractual return isn't as high as it has been historically, or the increment that it provides over treasuries to compensate for the credit risk isn't as high as it has been historically. But you can't say that they don't promise 7.5%. And a promise of 7.5%, you're going to pay some fees. You're once in a while going to encounter a credit loss. I think it's highly likely to provide, let's say, a return in the 6s over the next 10 years. A contractual guarantee approaching something in the 6s over the next 10 years is, I think, more defensive than being in the stock market at these elevated valuations. That's the point. You just said tighter than they have been since '98. If you looked at where they were in '98, and you hypothesized an investment in a portfolio of high yield bonds in '98, how did you do over the last 27 years? And I think you did fine. That's my point. It has a high probability of doing fine, whereas stocks, if the valuations are elevated, have some reasonable probability of doing less than fine.
Is the United States still the focal point for defensive investments?
I think I said in the memo that I think the U.S. is still the best place in the world to invest. The things that make the U.S. exceptional, the spirit of innovation, the free markets, the rule of law, the capital markets, the growth and dynamism, the great companies, these things are still all true. But as I said in the memo, we're the best place. We may be a little less best than we used to be. The world is thinking that maybe the U.S. is a little less best than it used to be, and I can't argue against that. I mean, fundamentally, as an investment environment, I think things are a little bit deteriorated.
Is there a place where you see has more opportunities right now just based on valuations and based on maybe a firming up of contract law and other aspects that really lead to a robust investment backdrop?
Well, as I say, I still think we're the best place in the world to invest. We're a great car at a high price. You can get some cars around the world that are not as great as ours, cheaper. Which do you prefer? Less good at a cheaper price, or better at a more expensive price? Other parts of the world do not have our dynamism. Lots of places in the world are overregulated compared to the United States. But if they're on sale relative to the U.S., it's not unreasonable to want to have some representation there.
Howard, wonderful to get your thoughts. As always, sir, you've been generous with your time. We appreciate it. Thank you very much. The legendary Howard Marks there of Oaktree Capital Management, following the release of his latest memo in the last week or so. I always skip to the conclusion, then work backwards. I do that with all the notes. The conclusion here on credit is interesting. I'll share it with you if you've missed some of that conversation. The narrow yield spreads mean today's prospective returns on credit aren't generous relative to those on risk-free assets in the context of history, but the returns are significant in absolute terms, competitive with the historical returns on equities, and supported by the issuer's contractual promise to pay interest and return principal, something that can't be said for stocks.
How do you analyze an equity market that's based on hopes and dreams and trying to price in some sort of multiple based on a number of expectations that cannot be proven out? And when that multiple gets higher and higher and higher, it starts to maybe reduce some of the attractiveness to people who are looking long term.
Fantastic piece from Howard Marks, The Calculus of Value. Check it out on his website on OaktreeCapital.com. Let's get you an update on stories elsewhere. Some breaking news just moments ago with your Bloomberg Brief. Here's Yahira.
Exactly, John. President Donald Trump posting on Truth Social that Fed Governor Lisa Cook should resign. The call comes after FHFA Director Bill Pulte wrote to Attorney General Pam Bondi asking to investigate Cook. Pulte accused Governor Cook of using falsified bank documents and property records to acquire more favorable loan terms. Meanwhile, President Trump met with the world's two biggest mining companies to discuss a copper project in Arizona that could supply the U.S. with a quarter of its demand. According to a LinkedIn post, the CEOs of Rio Tinto and BHP Group discussed the industry's capacity to deliver domestic supplies of copper and other critical minerals. And Indian Prime Minister Narendra Modi praising improving its relationship with China. This after India and China agreed on bilateral trade and investment flows to resume direct flights and process more visas. It's coming as U.S.-India relations are souring after President Trump threatened to boost tariffs unless New Delhi stops importing Russian oil. That's your Bloomberg Brief. John.
Hey, Yahara, appreciate it. Thank you very much. Up next on the programme, we'll set you up for the day ahead. Plus, Seema Shah of Principal Asset Management on that breaking news on the Federal Reserve. That conversation up next.
25 basis points doesn't change a lot there from our perspective, especially if you do have a shutdown in October, which we do think is a high probability. You hear, the president being upset about weak labor, and jobs numbers. And then at the same time, right, he wants to have this lower tenure, so he wants a stronger labor market and a lower tenure, and those two things can sometimes be in conflict.
That was Monica Guerra of Morgan Stanley on the program just moments ago, early this morning, on the Federal Reserve and the Fed's next move. The Fed's next move is in Jackson Hole, Wyoming, when the chairman gets the committee together and has a big conversation about the future. The elephant in the room is the political pressure coming from the other side of Washington, D.C., more specifically coming from the White House. This was the latest this morning. We've been tracking this story. The director of the Federal Housing Finance Agency, Bill Pulte, is urging the Attorney General, Pam Bondi, to investigate the Federal Reserve Governor Lisa Cook over a pair of mortgages. The president taking that story, putting it out on social media just moments ago, and writing this, that Cook must resign now.
This feels somewhat predictable in some ways because there has been a focus of reshaping the Federal Reserve. Putting some of the allegations aside, it just highlights how fraught this meeting is in Jackson Hole at a time where there is so much political focus on reshaping the way that they set monetary policy.
Framework review. How valuable is this framework review when we've got a lame-duck Fed chair and an administration pushing to change the Federal Reserve as an institution from the bottom up?
Yeah, people will be asking that question, and how much does that threat kind of loom large over some of the way that these things are shifted? Look, a real question here, and this is something that the market is looking for, is how much credibility will whoever comes into the Fed continue to lend to the idea of independence, and how much will global leaders on central banks try to edify that message?
Let's stay on this breaking news and bring in our next guest. So let's cross over to Seema Shah of Principal Asset Management. Seema, welcome to the program. Just want to build on this story just with you quickly. How do you view these developments, and how much pressure is on this institution going into Jackson Hole and their annual get-together?
Hi, John. Yeah, I mean, look, that pressure is clearly building day by day. It's one of the concerns that we've had in the last couple of months, is that you're going to see more and more of a politicization as you have more and more people joining the Fed who would be more aligned with this idea that, come whatever happens to the economic data, there should be rate cuts. So it is concerning, and we are getting close to a numbers game. We've already seen Steve Myron talking about 50 basis point cut. We've already got a number of Fed committee members talking about the 50 basis point cut potentially as a way, to advertise their availability to be the next Fed chair. This is getting to a numbers game. So I don't think, typically in a normal time, we wouldn't put too much emphasis on this latest news, but I think that this is a little bit more meaningful than what you would traditionally see.
Is it having an effect? I think that's the ultimate question for a lot of us in markets. When you look at market-based expectations of inflation, Seema, do you see them becoming unanchored in any way, shape or form off the back of these developments?
I don't think they're entirely becoming unanchored, but you are seeing this creep higher. So much is going to really depend on what the Fed chooses to do at the next meeting. A 25 basis point cut seems absolutely set in. If you're starting to veer to a 50 basis point cut, then I think you're going to get into slightly dangerous territory where people start to say, well, look, what in the economic fundamentals really justify that emergency size cut? And once you get to that point, then there's going to be question marks about inflation expectations. You get a push up in terms of term premia. Then you start to get to a point where actually the rate cut begins to backfire, and you could see the upward movement in 10-year Treasury yields and further up in the long end.
Seema, what are you hoping to hear on Friday when we do hear that speech from Fed Chair Jay Powell at 10 a.m. Eastern Time? Is there anything that he could come out and talk about, or would likely come out and talk about, that would alter the way you think about investment heading into year end?
Unfortunately, I don't think there is that much that is going to come out from Jackson Hole, which will be a real game changer. I think what we're likely to see, in a way which could be more impactful, is hearing from all of the other central bankers pushing back and really defending the Fed about the importance of independence. Now, in terms of the framework, to your point earlier, talking about a new framework when it's an outgoing Fed chair, and there's a ton of criticism with the potential for the makeup of the Fed to be fairly reshaped over the coming months. I do think that markets are going to treat it with a little bit of caution in terms of how much they're going to read into it and how much they're going to change their pricing off the back of that.
It seems like right now markets are coalescing around the idea that this isn't an incredibly strong economy in the United States. It's not an incredibly weak one either, but it's one that could warrant rate cuts in the near future. I'm just wondering how much you think that people are overlooking the weakness side of things that might drag down some of the valuations just on basic economic principles.
I think it still does appear in economic forecasts. I mean, when we do our downside scenarios, we're still allocating a 30% probability to a recession. So it is not, I think, completely ignored. But certainly if you're looking at the roll call of economic data, as you said, there is a cooling economy going on, but we're not seeing really clear signs that there is a meaningful slowdown. We are getting to the point where over the next 2 months, the economic data should give us a much clearer picture of the impact of tariffs. But, there's so much more to be said in terms of watching how the consumer is performing even before they start to maybe potentially feel the impact of higher prices. So we are at that bit of a cusp where it makes sense, certainly from my perspective, that maybe the Fed should start cutting rates. It's a question of how much they're going to cut rates and how much of the data dependence is starting to flow out of the Fed and maybe a little bit more politics coming in.
Seema, appreciate your time. Seema Shah there of Principal Asset Management. Got to take a beat. The calendar's shaping up. You know what it looks like. Jackson Hole Friday. Payrolls first week of September. CPI after that a week later. A week later, the Federal Reserve meets. Data could change the story all over again. Could completely upend this whole conversation just like that. One payrolls report.
I'm just thinking about the conversation that we had earlier this morning about the seasonality and how we've seen this movie before, that the first half is relatively weak and the second half is relatively strong. And that's my question. How much do we get head fakes here, given the fact that there are a number of influences, in particular the one big beautiful bill, that kick in later this year?
Jackson Hole just got a little bit more interesting for you and the team.
Look, I'm fascinated to go there. I want to see what they think about this labor market, how they're measuring it. I want to know. And I'm very excited to go hiking.
Travel safely, Bramo.
Thank you.
And enjoy the hike too. Looking forward to your coverage alongside TK. Coming up tomorrow, John Stolfus of Oppenheimer, the former Fed governor, Betsy Du, Tom Titsouris of Strategas, and Megan Robson of BNP Paribas. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.